issues are generally extremely well understood, so there isn't that much value in our trying to figure that out. But if you really understand how a company's business model works, how its industry is structured, the underlying trends impacting the industry, and where management is taking the company, there's a bit more opportunity to add value. That doesn't mean we own every stock for a long time, but we analyze and value it with a multi-year horizon. Morris Mark Asset Management. Typical investor behavior is to want to own things coincidental to success. So there are plenty of investors out there who will bail at any sign of disappointment. By extending our time horizon out 3 to 5 years, we're trying to take advantage of bargains that result when negative news and twitchy investors drive stock prices down. Sarah Ketterer, Causeway Capital. Most of the time, the short-term outlook stinks for the companies we end up buying, for company-specific or cyclical reasons. The best opportunities tend to be when the company now facing a lousy short-term outlook was not long before considered a darling of growth investors, and when the problems are now perceived to be more permanent. If you think those problems aren't really permanent, you can make very attractive investments if you turn out to be right. Jean-Marie Eviard, First Eagle Funds. We evaluate businesses over a full business cycle, and probably our biggest advantage is an ability to buy things when most people can't, because the short-term outlook is lousy or very hard to judge. It's a good deal easier to know what's likely to happen than to know precisely when it's going to happen. Whitney George, Royce & Associates. I have a ready answer when people ask me why I'm such a long-term investor, which is because I failed miserably as a short-term investor. I'm not against making money in the short term, I just don't know how to do it. Thomas Gaynor, Markel Corp. Chapter 4. Fertile Ground. Great ideas are the lifeblood of successful investing. Joel Greenblatt, whose Gotham Capital was one of the most successful equity hedge funds ever, and who remains active as a teacher, author, and managed index fund proprietor, distilled the essence of a great idea for us. There's a clarity that comes with great ideas. You can explain why something's a great business, how and why it's cheap for temporary reasons, and how, on a normal basis, it should be trading at a much higher level. You're never sitting there on the 40th page of your spreadsheet, as Warren Buffett would say, agonizing over whether you should buy or not. If you find yourself there, it's either not yet clear enough in your head or it's not as striking an idea as it should be. I can describe why we own the stocks we do in a few sentences. The hard work, of course, comes in proving the assumptions that get you to that point. But if you've done the work correctly, the actual idea ends up being very simple. The most money we've made has been on ideas that, once you look at it the way we did, were pretty obvious. The simplicity of the great idea, however, belies a more complex challenge every investor faces: how to focus attention on potential ideas that are more likely to be misunderstood by the market and therefore mispriced. Methods vary widely for homing in on such ideas and limiting the time devoted to running down blind alleys, but the best investors combine an avid curiosity with a keen ability to sift through the avalanche of available information to focus on the core elements of a company's situation that signal potential opportunity. They know and can describe well the situations they're looking for and the disciplines they use to find them. In search of uncertainty. While value investors are typically considered a risk-averse lot, that's more a reflection of the price they're willing to pay for any given investment than the types of situations they most often pursue, which are often fraught with uncertainty. As companies constantly evolve and change in response to industry or company-specific challenges and opportunities, the lack of clarity around those changes and the risks inherent in the potential outcomes can cause share prices to diverge widely from underlying business values. The ability to recognize and capitalize upon that dynamic is a key element of what sets top investors apart. There are two kinds of events that create volatility, which creates opportunity. The first revolve around individual companies, such as earnings misses, unexpected news, M&A activity, restructurings, and legal issues, things that can make prices and valuations change relatively quickly. In general, prices change much faster than fundamentals of business change. So what we want to do is understand what made the price change, and then figure out whether the facts have changed as much as the price. To the extent they haven't, that can be an opportunity. The other major source of volatility is when a macro event or trend causes markets to move. These can be industry-specific, but also reflect interest rate moves, currency moves, political instability, and the overall economic outlook. The market reflects at any moment what investors think XYZ's business is worth, so if macroeconomic factors force people to buy and sell its securities, but we believe those factors have nothing to do with the underlying fundamentals of the company, or less to do with the fundamentals than is being reflected in the share price, that can also be an opportunity. John Jacobson, Highfields Capital. Our reference to misunderstanding among our investment values refers to our having a variant perception versus consensus with respect to the earnings power or the free cash flow generating potential of the business. Some misunderstandings come from Joel Greenblatt "you can be a stock market genius" types of events, such as spin-offs, emergence from bankruptcy, and recapitalizations, where the movement of debt, equity, or assets around on the balance sheets leads to analytical complexity or some form of irrational selling. Variant perceptions can also arise from having a differential view about the ongoing business itself, such as new product launches, the impact of a change in management, or on how operating or financial leverage plays out over time. The key in almost all these cases is that something is changing. If a business has been around for 20 years and public for the last 15, it's hard to argue that people are really missing something if there's nothing relatively big going on. That gets to the importance of knowing why there is information asymmetry. If you can zero in on that, you're better able to handicap how likely you really are to be seeing something other people aren't. James Crichton, Scout Capital. Change brings uncertainty, so many investors want to wait out that uncertainty until the situation is easier to analyze. We think that uncertainty is what creates opportunities. Peter Langerman, Mutual Series Funds. You can usually only pay an undemanding price when there's fear or uncertainty associated with a name. That can result from a variety of things. When companies are restructuring, acquiring, or divesting, when a turnaround is necessary, either company-specific or in the industry, or when there's been a big operating disappointment of some kind. The common denominator is typically very low expectations. James Kiefer, Artisan Partners. The hedge fund industry grew up by preying on the inefficiencies created by the mutual fund mentality of only departing from a benchmark index weighting with reluctance. Events that transform companies can complicate things when you're focused on, say, having an 8% weighting in industrials. That's why these types of companies can often be mispriced. There's also change going on, and the market can be remarkably slow in shifting its focus from how things have been to how they will be. Gary Klar, Jana Partners. Companies going through operating or financial restructuring can go into a bit of an information vacuum, which can provide a good entry point into a position. There's often uncertainty about the specific programs being instituted. Management may be less apt to provide guidance, and because the change is ongoing, the results are by definition unclear. Jerry Sensor, Institutional Capital, LLC. We want to have a high conviction based on our research that we can achieve a 50% rate of return on long investments over a 2-year period. That potential return can come from any number of sources: turnarounds, changing product cycles, shifts in competitive dynamics, a revamp of the capital structure, or even cyclical recovery. The key is whether we believe we have an edge in understanding the magnitude or timing of the improved performance. Ellen Adams, Castle Rock Management. In our experience, it's revenue and earnings momentum that catapults a stock out of the swamp. We're looking for elements of positive change: fresh management blood, a changing market, a changing regulatory environment, a shift in competition, which suggest a future characterized by reliable and increasing earnings. We have to be predictors of growth to be able to buy at bargain prices. Carlo Canal, Canal Capital. You make a lot of money in stocks when they get revalued. We want situations in which the probabilities are favorable for margin recovery and a return to normal revenue levels coming out of a difficult period, which would result in multiple expansion. Alan Formier, Pennant Capital. We named our firm Thunderstorm Capital because a thunderstorm is a frightening but temporary event that usually passes without lasting damage. In constructing our portfolios, we try to invest in good companies whose stocks are depressed by frightening but temporary bad news. The trick, of course, is to distinguish thunderstorms from Category 5 hurricanes. John Dorfman, Thunderstorm Capital. The market missing an opportunity often has more to do with psychology around companies that run into trouble. Everybody knows the business is in trouble. Everybody knows the management is incompetent. If we take a more nuanced view, see some positives among the negatives, and have some insight into management's capability of turning things around, that's what makes it a good idea. John Osterweiss, Osterweiss Capital Management. We specialize in the highly complex while mostly avoiding plain vanilla, which is typically more fully priced. Seth Klarman, The Baupost Group. Financial complexity is one reason companies get mispriced. People talk about investing only in easy-to-understand businesses, but we're not afraid of tackling complicated financial analysis. If we think we can get a handle on what's going on, the fact that others tend to shy away from these situations can provide an opportunity for us. Curtis McGuinn, Ivory Capital. We're not reluctant to invest in pretty hairy situations. That by no means suggests complexity or controversy is always better, but it can often scare enough people away to create an opportunity. Tucker Golden, Solace Capital. Companies in severe financial stress tend to be overlooked and underloved because they have a risk or fundamental profile that many equity investors are not comfortable with. Mitchell Julis, Canyon Capital. What a lot of people don't realize about distressed investing is that you can do this type of investing in a low-risk way. By analyzing the capital structure and the underlying asset values, you can figure out with some degree of confidence at what point you're fully covered. If you're buying at 50 cents on the dollar and are comfortable that you're covered at 80 cents or 100 cents on the dollar, that isn't such a risky proposition. Peter Langerman, Mutual Series Funds. A legitimate case can be made that low-beta stocks are consistently undervalued by the market. Portfolio managers tend to favor high-beta stocks as a way to beat the market. If a portfolio beta is 2.0, the portfolio should double the market returns, right? Of course, it can go the other way as well, but with their bonuses dependent on beating the market, many managers are willing to take that risk. Bernard Horn, Polaris Capital. We don't like making assumptions about highly uncertain outcomes, such as how a new product will work or an industry transition will play out. If you look at most value traps, say newspapers or various industrials over time, they look extremely cheap if some significant problem goes away or isn't as bad as expected. I try not to deal in those big ifs. Therefore, many of the companies we own are quite boring, but they generate cash flows we believe we can value. Eric Cinnamond, Intrepid Capital. Avoid entirely what you can't totally get your mind around. It's just not worth it. There will be plenty of other things to invest in. Keep the cash for them. Amit Wadhwani, Third Avenue Management. Special situations. Frequently, the specific events that investors believe can create investment opportunity are prompted by the changing nature of the company's business. Maybe its core product line is maturing, its industry's growth has slowed, an ancillary business is booming, or it is investing heavily in new products or services. The emphasis is on change to which the company is responding. When smart investors' assessment of the ultimate impact those responses will have is at variance with conventional market wisdom, ideas can be born. We are often looking for broken growth stories, when a once great company is no longer considered to be great. The market tends to overreact in these cases, as growth and momentum investors move on to the next new thing, and the shareholder base turns. Since I wasn't in the stock before, I'm not disappointed if something is no longer a high flyer. All I care about is the future potential relative to what I have to pay for it. Alan Schramm, WellCap Partners. If you look at technology-driven growth industries over the past 2 centuries, steam engines, railroads, telephony, electric power, the internet, people become too excited about growth and overinvest in it. When the bubbles burst, markets overcorrect on the downside, even though the fundamental growth drivers may still be as present as they were before. We love to find jewels buried amid the rubble after that kind of explosion occurs. David Nierenberg, D-Cubed Family Funds. Most of the time we're picking up the pieces after a high-growth company hits the wall at 80 miles per hour, having made at least one too many investments to try to sustain an unsustainable growth rate. Public markets can actually conspire to screw companies up. When you're growing fast, you get this big P to E, and pretty soon you have all the wrong investors with ridiculous expectations. You try to meet those ridiculous expectations and do things contrary to shareholder value. Jeffrey Ubben, Value Act Capital. If you think about the life cycle of a small company, it usually initially succeeds in a relatively small niche where it delivers unique value and becomes a market leader. The business inevitably starts to mature, producing strong cash flow with a lower growth rate, and the natural response from management is to take some of the cash generated and to invest it in new areas of potential growth. Hopefully, these new growth initiatives are related to the core business, and hopefully the company can have some competitive advantage. This pursuit of incremental growth is exactly what management should be doing. One of two things will happen. Either the new initiatives work, everyone's happy, the stock has a high multiple, and we never find it, or the new growth initiatives are not working. The market becomes disenchanted with the company because earnings and cash flow are depressed, and that drives down the stock price. Those are the situations we find attractive. Jeffrey Smith, Starboard Value. We typically look for underperforming companies against their peers and their own history, and then try to understand why that's happening. Sometimes the answer is something we can't do anything about. In other cases, though, the underperformance may come from the company having wasted money over the past 3 or 4 years on acquisitions, and the market is concerned it's going to do it again and it isn't assigning full credit to its future cash flows. That's probably an opportunity for us. Ralph Whitworth, Relational Investors. In many cases, we're getting involved when a rapidly growing company is slowing down or maturing. There's a changing of the guard among the shareholder base, and as that happens, there's often a disagreement over how quickly the growth is slowing and whether the slowdown is permanent. When you're right that the market is overreacting to the challenges faced, the investment result can be quite positive. Wally Weitz, Weitz Funds. An area we try to mine is busted IPOs. Buying at the IPO often means you're buying from smart sellers, but we'd much rather buy from dumb sellers, which is more likely to happen after an IPO company disappoints in some way and the people who bought in the initial offering bail. Stephen Romick, First Pacific Advisors. We don't have any discernible edge determining whether IBM's earnings are going to beat the street by a nickel or whether the multiple should be 16, 18, or 20. We don't know where the price of oil is going or whether small cap stocks are going to outperform large caps. These things are really unknowable and unpredictable. But there are a wide variety of situations in which there are dislocations, like mergers, spin-offs, short-term bad news, legal issues, where we think we understand why there might be a huge disconnect between supply and demand for a given security. Then, if we can analyze what the true value of the business is and look across all the different securities on a company's balance sheet, we may be able to find something that's mispriced. It's analogous to going to Las Vegas on Super Bowl weekend and betting on the game. By definition, the line on the Super Bowl is the most efficient on the board. Every piece of information is completely disseminated, and the line is set by all the buyers and sellers coming together, of which there are thousands. The best bet on the board in Las Vegas is much more likely to be on a game between two college teams for which most people couldn't name the coach, any of the players, or even the team nicknames. But if you know one of the best players on a team is hurt, or that one team got in at 4 o'clock in the morning because there was a snowstorm, and the rest of the market doesn't know that, you have an edge making that bet. John Jacobson, Highfields Capital. One key situation we find of interest is when we believe unrepresentative accounting obscures the true value of the business. With DirecTV, for example, subscriber acquisition costs are expensed immediately rather than capitalized over time, which hides the true free cash flow. With Chesapeake Energy, the best deals they've done have been percentage interests they've sold in many key fields, but that they haven't booked in any of them, so that doesn't show up in returns on equity. It doesn't show up in earnings, and it doesn't even really show up in book value as receivables. Bad accounting is often a common denominator in many of our biggest positions. A second common situation is when the market seems to be making massively negative qualitative judgments that we believe, on deep analysis, are misplaced. With Chesapeake, everybody appears to hate natural gas forever and is angry at Aubrey McClendon, the co-founder and chairman who was forced to liquidate nearly all his company shares in 2008 to meet margin calls. So the incredible assets they have sort of get lost in the discussion. The last common thread would be when companies have an absolute jewel of a business that gets lost in the shuffle of a bigger conglomerate. Our success in Disney so far, and we believe in the future, is about ESPN, which nobody asks about on conference calls because they want to hear about movies or the animation business. With Olympus Corporation in Japan, it's about their medical device business, not their cameras. Ruddick is about the Harris Teeter grocery business, not textiles. Worthington Industries is about gas containers, not the steel business. Staley Cates, Southeastern Asset Management. We've always put emphasis on finding hidden value as hidden assets. We like looking at a multi-segment business where it's a bit more complicated to analyze all the parts, and there's not an obvious answer to the question of what the entire company is worth. In this context, we pay a lot of attention to private market values and trying to understand how underperforming segments should be valued. Peter Langerman, Mutual Series Funds. A common opportunity for us is when two businesses, which would trade on different valuation parameters if separate, operate under the same roof, resulting in the whole appearing mispriced. Timothy Mullen, VNB Trust. We like to invest in companies in which we think people are paying attention to the wrong thing. So, if 80% of investor attention is focused on something that you think is less than 20% of the story, it's a good opportunity to take a look at the business. Bill Nygren, Harris Associates. One key source of opportunity is when companies are building new assets that will generate incremental revenues, profits, and cash flows. Many times these are what we call inside-out growth stories, where a large legacy business is somehow perceived as challenged, but a newer one is thriving and taking on more prominence. Matthew Burler, Osterweiss Capital Management. We often see value in holding companies, where there are several disparate businesses and a single earnings multiple doesn't capture the true value, or in companies that own a significant asset that may not currently be earning anything but is quite valuable. John Jacobson, Highfields Capital. We find opportunity in looking at the different values ascribed to a company's different asset classes. If the debt markets would provide 100% financing of a company's total market value, that usually means the equity is undervalued. Whether Facebook is worth 15 times sales or 10 times sales is not something we'll take a position on. But if the debt market is telling us that a company's equity appears to be undervalued, that's something we're interested in. Steve Tannenbaum, Golden Tree Asset Management. At PIMCO, there are more than 70 different credit analysts covering just about every credit on the planet and producing research that very often has a valuable read across to the equity. That includes being on top of specific financing events that may be debt negative, equity positive, or vice versa. All of that is a very rich source of ideas and fundamental insight into companies. Charles Lahr, PIMCO. We find that geography makes a difference. The further a company is from New York, Boston, Chicago, LA, and San Francisco, the less attention and often less respect they get. In the 1990s, we started finding a lot of companies in the upper Midwest that weren't well followed, but had smart entrepreneurial managers who were building great businesses. Minnesota is still probably our favorite state for stock ideas. Scott Hood, First Wilshire Securities. Special situations, unfortunately, aren't as plentiful as we'd like, but include things like companies going through large reorganizations or companies that are being spun off. As well known as spin-offs are for being potentially mispriced, there appear to be enough structural reasons for inefficiency, having to do with limited information, forced selling, and management incentives, that they often still work. Over the past 30 years, the average spun-off company has outperformed the market by 10% per year. Timothy Beyer, Sterling Capital Management. We take a close look anytime a company is trying to create value through some type of spin-off or major restructuring, which can result in mispricings for the parent as well as the spin-off company. The documentation filed with the SEC when companies split up is quite complex, and the pro forma financials can be very fuzzy, dealing with tricky questions such as how debt and overhead are allocated, how assets are depreciated, and how costs will evolve in the separate companies. Most people don't do the work of going through what can be hundreds of pages of financials, but we find it can often uncover interesting ideas. Edward McCary, Williamson McCary Investment Partners. Often spin-off opportunities are bond-like in nature, generating a lot of cash with a great base of assets and excellent incentives in place for the right things to be done with the cash generated. But the numbers generally don't look so great at the beginning because it's in management's interest to under-promise and over-deliver. Coupled with the fact that the shareholder base is usually in flux at the beginning, many holders of the parent company's stock don't want to, or, because of their charters, can't own the spin-off. Inefficiencies arise. Mitchell Julis, Canyon Capital. Many times, companies find themselves in what the market considers predicaments because they have been far-sighted and are spending on future opportunities. The good thing about that type of spending from a shareholder standpoint is that if the company is right, you benefit, and if it turns out to be wrong, it stops spending the money and you also benefit. Murray Stahl, Horizon Asset Management. Most companies expand during good times and wind up over-leveraged and with too much capacity when the business goes south. We like to see the opposite, companies today investing on the cheap in additional capacity for when things turn up. James Vanasek, VN Capital. Obviously, just because a company makes a new long-term investment doesn't mean it's the right one. As an investor, though, the existence of controversial initiatives like that creates a potential buying opportunity. It's up to you to decide whether to pursue it or not. Thomas Russo, Gardner, Russo & Gardner. At the peak of the Internet bubble, I went to an investor presentation by check manufacturer Deluxe Corp, in which they described how the Internet was going to flatter, not tarnish, the check business. And then the CEO launched into a big discussion about how he was going to convert his core franchise to a new platform he called Internet Gift Sales, and that they were going to lose $50 million a year on it. I went away and didn't buy the stock, disgusted with that idea. What I learned from this, however, was that really dumb ideas like this one actually have a habit of meeting an early death. In fact, it turned out to be such a dumb idea that it died quite quickly, leaving the business to flourish under its core dynamics, unburdened by ill-considered strategic moves. That was a big lesson. Thomas Russo, Gardner, Russo & Gardner. Operating turnarounds. The bad news that typically precipitates the need for an operating turnaround as well as the ongoing uncertainty that revolves around management's turnaround effort, can wreak the kind of havoc on stock prices that value investors are keen to capitalize on. That a company is in turnaround mode, of course, doesn't mean the turnaround will be successful. That makes the ability to distinguish eventual winners from losers in the turnaround game an essential, if decidedly non-trivial, skill in any contrarian investor's toolkit. We're looking for the prospect of an accelerating rate of positive change. That means we're naturally drawn to management changes, turnarounds, or more generally, to situations in which changes in the macroeconomic, competitive, or regulatory landscape require a company to remake what it does or how it does it. Sometimes it's even more straightforward, where we see unrecognized assets that can generate significant value, or when a company blew something like an acquisition or a product rollout, and we believe the fix will happen more quickly and with less pain than the market expects. Mariko Gordon, Taruma Capital Management. We search for companies in which change can alter the future for the better. That can mean change in management. It can mean a change in management's attitude toward running the business, say by recognizing that 120% of the earnings come from 80% of the assets, so they should do something about that other 20% at some point. It can mean a new business opportunity that has yet to take off. It can mean a change in the dynamics of a company's cash flow and how it's to be used. If we perform our analysis correctly, the value added we bring is an earlier and better understanding of the companies in our portfolio than other investors might have. If the companies then begin to improve, their earnings should increase, and they're likely to earn a higher price-to-earnings multiple. Dennis Delafield, Delafield Fund. We're looking for businesses that are going through some kind of transition, in management, in the business mix, in the industry. Often, a previous management team overextended and overleveraged the company, and somebody new has been brought in to straighten it all out by cutting costs, selling assets, or paying down debt. A good business that happens to have a bad balance sheet is much easier to fix than the opposite. James Rooney, Avenir Corp. Just because a company is capable of throwing off lots of cash doesn't mean they're doing so at any given moment or that they're using the cash correctly. We value investors first, so we're looking for depressed stock prices. Often what causes a depressed stock price is a misallocation of free cash flow through ill-timed or ill-conceived acquisitions, pouring money into bad businesses, or any number of wrong capital allocation decisions. But those tend to be fixable problems, which is a lot easier to do when the core business is intrinsically healthy. Andrew Jones, North Star Partners. Missing a product cycle, for example, is generally fixable. So are problems that result from a company's outgrowing its infrastructure. It's a high-class problem to have, but it can result in some real earnings trouble. Botched acquisitions can also create interesting opportunities if we believe the delayed cost savings or strategic benefits will eventually show up and increase earnings. Kevin O'Boyle, Presidio Fund. Our experience shows there's a positive correlation between improvements in a company's return on invested capital and its stock performance. That makes sense, given that a company's earnings today are the result of project spending it made in the past. We obsess over ascribing value to today's capital projects, as well as on deconstructing businesses into their component parts, so we can better value the existing asset base. More than anything, we're looking for inflections in businesses where some sort of structural change will drive returns on invested capital to be materially higher. In all of our conversations with companies, their competitors and their suppliers, we're trying to identify structural changes that we can get ahead of and believe will result in better returns on capital. I'd say at least half the time it has to do with new leadership changing how things are done. For example, we love when management or a board changes compensation systems to move from a grow earnings per share driven culture to one focused on returns on invested capital. Joe Wolf, RS Investments. 3 to 5 year turnarounds almost always require a deep infusion of outside management talent, a change in culture, an overhaul of the cost structure, and some fairly dramatic shifts in operational execution. We want to identify these potential turnarounds early, but it's often only after a year or so of careful study that we're ready to act. Depending on the situation, we want to see tangible evidence, say an increase in gross margins, declining inventory levels, or reduced operating expenses, that the turnaround is working. If we believe the shares can double or triple if we're right, which isn't a stretch if earnings and valuations are starting from particularly depressed levels, we have no problem leaving the first bump in the stock price on the table. We're helped by the fact that once the market has given up on a company, it can be quite slow to embrace it again. Lloyd Connor, Connor Capital. Management changes can help a lot with timing. If a board of directors is serious about restructuring, they'll often hire someone from a best-in-class company to make it happen. Those people aren't cheap, which shows the board is serious, and the fact that the person is willing to come indicates they think they can add value. An executive from a first-class company taking over a laggard can mean an opportunity is ripe for the picking. Philip Tasho, Tamro Capital. While management changes aren't always necessary, we often view management changes positively in turnaround situations. You're much more likely to get a frank, thorough appraisal of what has gone wrong and why, so you'll probably understand the situation better. My confidence also increases when a strong new manager has been attracted to a situation and is highly motivated to perform. Kevin O'Boyle, Presidio Fund. My best ideas by far have been in situations where a new CEO takes over an undermanaged franchise. If we only focused on one thing, that would be it. The market just does not pick up on the ramifications of change quickly enough. The big question after identifying a CEO you have confidence in is getting the timing right. You can't wait for the CEO to come out with his restructuring plan in front of 250 analysts. The best thing is when you already know the person and the business and can act very quickly after the new CEO is named. Kenneth Feinberg, Davis Advisors. What will get me excited is when one of our analysts comes into me with a story like this. Preston, I've been following this stock for 2 years but haven't found a good reason to write it up. It used to be kind of a high flyer, but the stock chart now looks like death warmed over. The shares were at $40, had a big drop, and have been trading between $15 and $18 for months, and nobody cares. The company is likely to have some big write-offs this year to clean up the balance sheet. And by the way, 2 months ago, the board fired the CEO, and the new guy is someone I know from a previous company where he did a great job. He's not even talking to the street for 6 months as he gets a handle on things. Preston Athey, T. Rowe Price. Stock prices go up for 2 primary reasons. The first is investors' willingness to pay a higher multiple for a company's earnings or cash flows. That's what traditional value managers look for, undervalued securities that will be more richly rewarded in the future. We're trying to find that as well, but we're also looking for evidence of fundamental turnarounds and the additional stock price upside that comes from higher earnings expectations. Ronald Mushok, Systematic Financial Management. The primary reason to invest in a turnaround is when you're able to invest in great management at value prices. The best people are attracted to a challenge, but the fact that it's a challenge keeps valuations in line early on. Wall Street tends not to believe something is turning until it's fairly obvious, which can give you time to do real work and build your position before the market starts paying attention. Even in poor market environments, turnarounds can do well because they're usually coming off such low bases. As a result, we find that our results are less correlated to the overall stock market, especially in down markets. Lloyd Connor, Connor Capital. As a general point, we aren't seeking classic turnarounds. If we look back at mistakes we've made, particularly in smaller cap companies, it's been when we needed some fundamental problem to be fixed for the investment to work out. We've developed a healthy respect for how hard it is to turn a business around. Timothy Harch, Brown Brothers Harriman. Getting turnarounds right is very tough. It takes a tremendous amount of research effort. The turnarounds almost always take longer than you expect, and it's just easy to get it wrong. That doesn't scare us away, but we're very cognizant of the risks. We're unlikely to act until we see tangible signs of the turnaround happening or some clear positive sentiment from the industry or management. Scott Hood, First Wilshire Securities. The first basic thing I look for is that the business is currently profitable, which means generating good returns on capital without the excessive use of leverage. I was tempted in my youth by turnaround stories or betting on new product or service offers, where you could hit the ball out of the park if things got fixed or the new product took off. But I've had enough failures pursuing those types of ideas that I've for the most part lost the stomach for them. From a performance standpoint, I'm more focused on what something is than what it can be. Thomas Gaynor, Markel Corp. We don't do turnarounds. What attracts us to the whole concept of value investing is the idea of having a margin of safety in terms of value over price. That margin of safety only exists if values are stable, and it only improves if value increases. With turnarounds, you're making a bet, maybe a very intelligent one, but still a bet, that something broken can be fixed. Even in the best case, you may be looking at years when value declines or stagnates. Our experience is that we're better off investing in a good business that is constantly compounding value from the beginning of our ownership, without what to us is the unacceptable risk that the turnaround doesn't work. We just don't think we need to take that kind of risk to earn strong returns. C. T. Fitzpatrick, Vulcan Value Partners. Not to be flip, but all we count on in a number of our investments is just for things to return to normal. There's a lot less risk in wanting that to happen than looking for some huge transformation in a company's business. Christopher Grisanti, Grisanti Brown and Partners. Chapter 5. Generating Ideas. The active quest for ideas is a universal component of every investor's toolkit, but the methods chosen to do so are often all over the lot. Some investors use computer screens extensively, for example, while others don't use them at all. Some frequently pursue top-down ideas sparked by an industry trend or secular change, while others pursue only ideas that bubble up individually. Regardless of the methods employed, however, the idea generation process typically reflects the same abiding curiosity and dogged pursuit of information seen in the research and analysis efforts that follow. Behind the screen. The ever-increasing sophistication of financial and market databases and the technology available to use them make it easier and easier for investors to screen on all manner of attributes in the search for prospective investments. To the extent to which top investors take advantage of that capability, however, is far from uniform, ranging from not at all to a near total automation of the initial idea generation process. Similarly diverse are the metrics on which they screen, not surprising given the diversity of company characteristics on which they focus. I do a lot of screening, which can be a valuable check on emotion, if you like. I wouldn't necessarily suggest blind faith in them, but there is a degree of honesty about numbers that can be quite useful for disciplining yourself when looking at potential opportunities. James Montier, Société Générale. We often start with screens on all aspects of valuation. There are characteristics that have been proven over long periods to be associated with above-average rates of return: low P/Es, discounts to book value, low debt-to-equity ratios, stocks with recent significant price declines, companies with patterns of insider buying, and, something we're paying a lot more attention to, stocks with high dividend yields. Will Brown, Tweedy Brown Company. Our heritage has been very much to focus on traditional value metrics of low P/E, price-to-book, and price-to-sales ratios. An initial screen for us might be looking for stocks trading at less than 2 times book value, less than 1 time sales, and less than 15 times forward earnings. That's still at the core of what we do, but we've evolved to also screen on a variety of other metrics. We have a Joel Greenblatt screen, for example, looking at stocks with a combination of high earnings, yields, and high returns on capital. We also look at a variety of balance sheet measures, including basic things like net cash versus market value. The art part of the process comes in deciding which companies that screen well deserve more fundamental analysis. The keys here are usually an initial assessment of the quality of the business and its growth potential. We want to buy cheap, particularly relative to where the stock price is historically traded and where companies in its industry should trade, but usually only when there's real potential for growth. John Buckingham, L. Frank Asset Management. We start by screening for classic value. That could be a low price to net assets ratio, a low premium or a discount to book value, a P/E ratio less than the return on equity ratio, or, depending on the industry, a modest premium or a discount of the market value to revenues. We also have various screens that try to predict a buildup of cash. Companies that continually generate cash above and beyond their capital expenditure requirements are hopefully going to do good things with that cash, and shareholders should benefit. Carlo Canal, Canal Capital. We screen for financial metrics that may show symptoms of the types of situations we look for. Say, revenues have been flat for the past 3 years, but operating expenses have increased in each of those years. We also typically look for companies that are underperforming on any number of profitability or productivity measures against peers and against their own history. Because they're under-earning, many of the companies that interest us look expensive based on current numbers, but are actually undervalued relative to the pro forma earnings that can be generated if our plan is implemented. Peter Feld, Starboard Value. We have a computer model that ranks our value universe of the 1,000 largest domestic companies. It ranks all 1,000 companies from cheapest to most expensive, on the basis of current price to the normalized earnings we extrapolate from history 5 years into the future. From this computer screen, we do an initial review on the cheapest quintile of these stocks, looking more closely at the company financials and the industry dynamics. After this initial research, we reject about 75% of these companies. The other 25% we do detailed analysis on, including visiting the company and meeting management. Richard Pazina, Pazina Investment Management. Some of our most successful screens look to identify businesses that are either short on capital or have excess capital. James Crichton, Scout Capital. Our basic screening process weighs 3 factors equally: return on tangible capital, which we define as operating cash earnings over working capital plus net property, plant and equipment, the multiple of earnings before interest and tax to enterprise value, and free cash flow yield. We rank the universe we've defined on each factor individually from most attractive to least, and then combine the rankings and focus on the top 10%. Stephen Goddard, The London Company. We look at all the usual valuation screens to identify stocks that are cheap relative to book value, earnings, and cash flow. I'm also interested in companies whose margins are significantly higher or lower than they've been historically. John Jacobson, Highfields Capital. Since we're trying first and foremost to limit our downside, our valuation screening is centered on where the stock is trading relative to its own history. We look at various measures, but we basically go back as far as we can and calculate for each calendar year the high multiple of cash flow, say, and the low multiple of cash flow at which the stock traded. The cash flow number we use is for that entire calendar year. From that, we determine the median high multiple over the entire history and the median low. We'll then look at the upside to that high and the downside to that low from today's multiple on current year estimated cash flow and calculate what we call a favorability ratio. We want to do further work only on companies where the favorability ratio is at least 3 to 1, meaning the upside to the median high valuation level is at least 3 times the downside to the low. In other words, for the multiple part of the return equation, we want the odds in our favor. Brian Krawes, Scharf Investments. Having an edge as an investor is a bit like having an edge as a radiologist or a mechanic or a pilot. The edge comes from being able to see patterns and reliably diagnosing what they will mean. I'd like to think that the combination of inputs we use to correlate and predict is somewhat unique to us. In identifying potential short sales, for example, seeing decreasing inventory returns for a company audited by a non-Big Six accounting firm is an interesting correlation. Or we might draw some conclusions over an increase in the gap between cash flow from operations and net income, combined with increasing analyst coverage of a company. Carlo Canal, Canal Capital. The long-term rate of return on equities in this country is in the neighborhood of 10%, which correlates closely to the actual return of owners' capital for all those businesses over time. My premise, then, is that the return all earn on a stock, absent distributions and assuming a constant valuation, will approximate the company's ROE over a number of years. So, we choose to swim in the pool of companies where the returns have been much better than average and where we believe over the next 5 to 10 years that opportunity will remain largely intact. And because you're saying, Akri, you fool, you know we don't have constant valuations, we also work hard to pay low valuations at the outset. Chuck Akri, Akri Capital Management. One of our best screens looks for companies that are earning higher and higher returns on invested capital, but are trading at a reasonable price based on free cash flow. These companies are becoming incrementally better businesses, but the market has not caught up with the fact that they're incrementally better. Zeke Ashton, Centaur Capital. Most of our initial research is on finding the true standouts in any given business. That's largely a numbers-driven exercise, focusing on returns on equity, margins, and growth in key sales and profitability metrics, all in comparison with the competition. We've identified more than 400 companies, primarily in the U.S. but not exclusively, that we could imagine owning and that we try to keep fairly close track of. François Rochon, Giverny Capital. We consider ourselves first and foremost value investors, but we don't start by looking for cheap stocks. We spend our time following outstanding businesses that we would want to own should they ever become cheap. They're rarely inexpensive when we start trying to understand them, but we follow them closely so that, on the rare occasion they become discounted, we can act right away. Coming at it this way also means we're not wasting our time chasing statistically cheap companies that we will have no interest in owning. Time is precious in this business. C.T. Fitzpatrick, Vulcan Value Partners. With the market as volatile as it has been, we've been more diligent about maintaining watch lists to catch companies whose stocks trade off sharply for reasons that may be more overall market-related. We're not looking for short-term trades, but as we learned in late 2008 and early 2009, stocks of even the high-quality companies we want to own can get remarkably cheap quite fast. We want to be prepared for that. David Nierenberg, D-Cubed Family Funds. One important change we've made is to develop a well-maintained list of companies we would want to own at the right price. Because of the suddenness of the 2008 crisis, there were so many securities on sale that we were a bit paralyzed in trying to analyze them all. We've made the investment to stay current about on-deck ideas so we can act more quickly when opportunities present themselves. Jason Wolf, Third Avenue Management. Our best ideas tend to come from what I call old research, new events. That's typically the good company you've studied carefully and would love to own at the right price that gets marked down after it trips or its industry goes out of favor. Ricky Sandler, Eminence Capital. Tapping into our own prior work has probably produced the largest number of ideas. The risk is that you let the prior experience, whether you bought into something or not, bias your view. We try to stay cognizant of that, but just find it can be very helpful to leverage the head start we have from work we've already done. We've tried to automate some of the process by setting up stock price alerts on companies we've already analyzed, but it isn't an exact science, as target prices can become obsolete fairly quickly. Tucker Golden, Solus Capital. I've concluded that if you find yourself going back to the well with the same idea a third time, you're not generating enough ideas and are likely to get killed. You're not as vigilant as you should be because you think you know it already. When I find myself doing that, I tell myself I'm just not working hard enough. Jeffrey Ubben, Value Act Capital. One narrow screen I like targets insider buying. When a lot of insiders are buying, I don't care what the valuation is. That's always an interesting signal. Zeke Ashton, Centaur Capital. We often look at cases in which a company with significant insider ownership is aggressively buying back shares, but the insiders don't participate in the buyback. That indicates that someone who may know more about the business wants to own more at a particular price. Robert Rabati, Rabati & Company. We don't take all insider buying and selling at face value. Some people and some trades you pay a lot more attention to than others. When a founder CEO who has 100% of his net worth in a stock buys another $10 million worth on the open market, that's interesting. When a director buys nearly $100 million of a company stock, that's interesting. When top management is exercising options that don't expire in 15 years, that makes us leery, especially when they're publicly talking about how great everything is at the company. Stephen Goddard, The London Company. We basically spend our time trying to uncover the assorted investment misfits in the market's underbrush that are largely neglected by the investment community. One of the key metrics we assign to our companies is an analyst ratio, which is simply the number of analysts who follow a company. The lower the better. As of the end of last year, about 65% of the companies in our portfolio had virtually no analyst coverage. Carlo Canal, Canal Capital. We want to know the level of attention paid to the company by Wall Street, much preferring those that are underfollowed and for which there are low expectations. The blessing of low expectations is that being right about things turning out better means the stock will probably do quite well, while being wrong usually means not much happens, because the low expectations are built into the share price. James Shercliffe, River Road Asset Management. We look for companies that don't have heavy institutional ownership and for which the sell side is generally negative, but that we think are addressing their failings through management and strategy changes. Often we're just trying to do the work early before sell-side analysts jump on the story and the company finds its right shareholder base and valuation level. Gary Clark, Jana Partners. We do exactly one screen, which is to segment our potential opportunities by market cap. Starting with a rank order valuation screen is more likely to lead you into less than optimal businesses, which we can't afford to be in with such a concentrated portfolio. Brian Bears, Bears Capital. One thing we don't do is a lot of computer screening for ideas. I've always considered screens to be too backward-looking. Many of our best investments would have screened very poorly, with negative cash flow, horrible returns on equity, declining sales, and suspect management. We're trying to look beyond all that to the changes in management or changes in the business that can correct the problems. The key for us is to be able to make a credible case for the company looking very different in 2 or 3 years from how it looks today. John Osterweiss, Osterweiss Capital Management. We don't do traditional screens and are actually looking for situations in which the publicly available information that a computer can analyze is giving false signals. For example, we bought auto insurer Progressive in 1999 when their earnings looked bad because they were spending heavily on a direct-to-consumer strategy like Geico's. A computer would see that as a negative earnings trend resulting in a too high multiple, but it doesn't know how to judge whether certain spending might generate big returns in the future. Boykin Curry, Eagle Capital. Follow the lead. The pursuit of good ideas is often a more top-down and iterative process than implied by the heavy use of computer screens. A trend, a theme, or even a throwaway line in an obscure industry journal inspires a line of inquiry that is always filled with blind alleys, but from time to time uncovers a mispriced gem. It's very important to define where you're going to look for opportunities. Time is a precious resource, and if you make it your priority not to miss anything, you set yourself up for failure. There are too many opportunities out there, and by definition, you will miss many of them. That's why we narrow where we want to look first by the themes we consider most compelling. We're not necessarily seeing things others don't see, but we will likely have a very different view on the magnitude of the trend or the speed at which it happens. Oliver Kratz, Deutsche Asset Management. Our ideas typically have more to do with the trends in a particular industry than whether XYZ stocks look very cheap. We want to invest in good businesses with industry or company-specific tailwinds behind them, and which happen to be cheap. That's a different mindset from finding something that's cheap and constructing a story about why the negative issues should go away. Brian Barish, Cambiar Investors. We take the traditional value investors process and just flip it around a little bit. If you're looking for something that's cheap, you'll probably do a variety of screens on price to sales, price to earnings, price to book, whatever, to identify stocks that appear to be inexpensive. Once you have that list, then you start to research if there are good reasons the stocks deserve to be cheap, or if maybe there's an investment opportunity because they're cheap without a good reason. We think that's the way most value investors approach it. We never do screens like that. We start by identifying situations in which there is a reason why something might be misunderstood, where it's likely investors will not have correctly figured out what's going on. Then we do the more traditional work to confirm whether, in fact, there's an attractive investment to make. That's as opposed to starting with something that's just cheap and then trying to figure out why. We think our way is more efficient. David Einhorn, Greenlight Capital. I'd say most of the ideas that have made money for the portfolio have been the result of some form of reasoning by analogy. One example of that is applying well-understood and successful U.S. investment ideas to markets outside the U.S. Guy Spear, Aquamarine Fund. As we extend our time horizons, we try to think about things not just unique to one security or situation, but applicable across a bigger industry trend. Thematic umbrellas help us organize our thoughts about bigger opportunities. We then go systematically one company at a time, one security at a time, to try to identify where we can find the best investments. Larry Robbins, Glenview Capital. For me, it's all qualitative and contextual. Once you begin to research an industry, you have to survey the entire landscape to understand it, from the competitors within the industry to the competitive threats from outside the industry. Ideas naturally flow out of that process. Thomas Russo, Gardner, Russo & Gardner. Many opportunities I pursue have a thematic top-down element, where an industry structure or certain situational dynamics are a tailwind of the company's business. It may be the industry has consolidated or supply is otherwise tightening, resulting in pricing power for the key players. It may be a company with a structural cost advantage that will allow it to take market share and accelerate revenue growth over a long period of time. The point is that I focus on the fundamentals of the business first, not on how cheap the stock is or how much it's off its 52-week high. That helps me avoid value traps and/or businesses with structural challenges. Jed Nussdorf, Soapstone Capital. We believe our job is to look out 2 or 3 years to identify who's winning and who's losing in each industry and to recognize the discrepancies between our views and the market's views. Given the depth of industry experience and resources our sector heads have, it would be unusual for someone to call us with an idea that we don't already have some knowledge of. As a result, the vast majority of our ideas come from thinking through the ramifications of industry developments or the recognition of changes within a market, as opposed to the one-off, here's an idea, let's chase it down approach. Lee Ainslie, Maverick Capital. We like it when expectations are very low and we have a contrarian view on a broader issue impacting the company. Low expectations help limit the downside and can result in prices that leave you paying nothing for the upside if good things happen. Jeffrey Schwartz, Metropolitan Capital. The majority of our investments are originally driven from the top down. We'll identify an industry that has underperformed for the past 5 or 10 years that we believe is due for a cyclical regression up to the mean. From that, we systematically review the whole universe of microcaps in that industry, sorting them on the basis of financial measures and subjective assessments of management to identify the companies we'll bore into. David Nierenberg, D-Cubed Family Funds. One thing Peter Lynch, of Fidelity Magellan fame, did really well was to figure out how else to make money on a good idea. Look right down the industry structure and figure out the other ways that this particular information can generate an edge. In our portfolio today, we identify a theme, and then we try to figure out where all the opportunities are. Jeffrey Ubben, Value Act Capital. You never know where your research will take you. Say you're interested in copper. You may start with the mining companies, then move to the refiners, then the intermediate processors, then the metal blender manufacturers, and on up the line. If one area of the business looks particularly lousy, you may want to look at the companies that buy from those people. You may look at the competitors or the alternatives to copper. 35 companies down the road, you're likely to be in a completely different business and industry, and you'll come across something that looks interesting. James Vanasek, VN Capital. It's hard to have unique insights in this business, but they often just come from working on something that leads you to something else. I work with 2 analysts, and every once in a while we'll say, let's brainstorm about new ideas, but I can't say we've ever come up with an idea that way. Ed Wackenheim, Greenhaven Associates. It's kind of a bizarre conversation to have, but we actively discuss what isn't being talked about. Maybe an industry is at a low point in its cycle, where our favorite company would be one that is still making money and looking to expand while competitors are losing money and retrenching. If a commodity is trading at a multi-year low, we'll look at the producers of the commodity who may be suffering. If a commodity is at an all-time high, we'll look at companies that use the commodity as a raw material and are getting hurt as a result. This all becomes a starting point, and then we wander around from there. James Vanasek, VN Capital. Not to be overly simplistic, but a lot of it comes down to following the news and reading. You never know what might jump off the page and say, look at this. As an example, years ago I was reading an article in The Economist in which someone was talking about emerging consumerism in Asia, and there was a single line saying something about how this company, that company, and Lot Confectionery might be beneficiaries. I'd never heard of Lot Confectionery, but as I looked into it, I found out not only that it was a large global candy and sweets company based in South Korea, but also that it was cash flow positive and its stock was trading at around net cash per share. You obviously end up hitting a lot of dead ends, but I've found plenty of things no one else seems to be paying attention to in this way. Chris Middleman, Middleman Brothers, LLC. I think there are very few truly original ideas, so a lot of our short ideas come from what I call observational common sense. We talk a lot to people we respect in the business. We read everything, looking for patterns we've seen in the past that led to good ideas. It doesn't have to be negative news. Often you read a bullish article or report, and you can just tell the writer is missing it, that there's something wrong and it's worth a look. We're also avid observers of human behavior, looking for cases where people can collectively lose their minds for longer periods of time than you could imagine possible. James Chanos, Kinnikos Associates. Many of our other ideas just come from having our eyes wide open. You read publications like yours. You talk to contacts you've developed in various industries. It's often just about paying attention to what's going on in the world. Ricky Sandler, Eminence Capital. We don't have a rigid process, but there are always linkages. My first investment 20 years ago was Fireman's Fund. Studying Jack Burns' resuscitation of Geico before going into Fireman's Fund led me to Berkshire Hathaway and this guy Warren Buffett. Then, during the banking crisis in the early 1990s, I looked at many banks, but chose Wells Fargo because Warren Buffett owned it. Bruce Berkowitz, Fairholme Capital. We have a disciplined idea generation process, but it has to be open to serendipity. Often it's the footnote in the trade journal where you see something interesting that eventually becomes an idea. Sean Kravitz, Esplanade Capital. Reliable sources. Each investor brings his or her own experience base, strategy, and acumen to the information filtering process in looking for new ideas. Therefore, it's not surprising that the information-gathering process in pursuing ideas, while often clever and creative, need not necessarily be that proprietary, sophisticated, or even original. For the last 40 years, I've been reading things like Variety and Automotive News and Farm Journal that give you an idea of what's going on around the world. A story that has always stuck in my mind since I first heard about it in high school is that in World War II, an Allied intelligence analyst was reading the social papers and wondered why all these German generals were going to a particular location in the middle of nowhere. He figured out that it was the location of a factory making German V-1 bombs and sending them to England. The hard part is connecting all the dots, but you have to assemble plenty of dots to connect in the first place. Mario Gabelli, Gamco Investors. I like to have information pushed at me, so I've kept up keyword alerts on something like 3,000 companies, which results in 20 to 25 press releases a day announcing things like management changes, reorganizations, or new dividends. Ideas come out of that all the time. Another thing I've done in my personal account is to buy one share of probably 250 microcap companies, which is kind of my own customized research service. The daily mail delivery is a kind of a Christmas grab bag. You never know when an annual or a quarterly that arrives is going to catch your eye. One last thing I'd mention as an idea generator is tracking new lows lists. I always say margins of safety are created out of broken dreams, and there's a fresh list of those broken dreams published daily for us to hunt through. Paul Sonkin, Hummingbird Value Fund. We screen a lot on the metrics you'd expect for companies with a combination of low valuation and high business quality, but we also like to search article databases using keywords that indicate problems or big changes at a company, things like profit warning or spin-off or restructuring. David Samra, Artisan Partners. We've over time built a number of systems and reports that enable us to track globally the movement of debt, equity, and assets around on balance sheets. We follow in a disciplined way things like spin-offs, rights offerings, new equity issuance, and buybacks. James Crichton, Scout Capital. You can usually only pay an underlying price when there's fear or uncertainty associated with a name. If I was stranded on a desert island and was given only one way to come up with investment ideas, I'd want to see the daily list of biggest percentage decliners. There's no better indicator of fear and uncertainty. James Kiefer, Artisan Partners. We look at the new lows list for long ideas and the new highs list for short ideas. I look at the 13F filings for 20 to 25 other investors I respect to see what they're buying and selling. Bloomberg also on a monthly basis has the highest ranked and lowest ranked stocks by sell-side analysts. I look at the lowest ranked for buying opportunities and the highest ranked for selling opportunities. John Jacobson, Highfields Capital. We use a lot of grapevine ideas, asking people what they have finished buying and that might be interesting. Why wouldn't you look at what other great investors have found? Bruce Berkowitz, Fairholme Capital. It's always interesting if those who have filed with the SEC as 5% owners are names we respect. Historically, if we see Marty Whitman's name, we like it. If we see the T. Rowe Price Small Cap Value Fund, we're happy. David Nierenberg, D Cubed Family Funds. We follow 13D and 13F filings of other people we respect. We read publications like yours. I'd much rather steal a good idea than generate a bad one myself. Steve Morrow, New South Capital. We get a lot of ideas from studying what people we respect are doing. We sit on panels, go to conferences, and regularly pick up the phone and talk to our friends in the business. As you get more experience, the network you've built becomes a resource that is difficult to replicate. John Rogers, Ariel Investments. We learn a lot from other investors. I go to idea dinners and regularly talk to a lot of people I respect in the business. I'm not afraid of ideas owned by other people, but you obviously need to do your own work and make sure they fit what you do. There's no shortage of people trying to put ideas in front of us. We won't invest without doing our own research, but the give and take with other thoughtful analysts can spark ideas. James Rooney, Avenir Corp. Probably half our ideas are generated internally in the normal course of business, from speaking with portfolio companies, their competitors, customers and suppliers, or from the reading we do to research any given company and its industry. Another 25% or so of our ideas come from more niche brokerage and research firms with whom we've had a good experience. We get the balance of our ideas from other buy-side investors we know and respect. Other investors are particularly helpful for getting a quick take on the bull and bear case for any potential idea. That's not at all a replacement for doing our own work, but it helps focus our attention as we try to determine if something is worth a deeper dive. Robert Kirkpatrick, Cardinal Capital. I don't talk much to other fund managers, but I do have a network of investigative reporters I've gotten to know who can call me from time to discuss long or short ideas they've come across, which can be helpful. Francois Parento, Defiance Capital. We find that Wall Street research does a fairly good job of describing the economics of any industry, but a bad job on reaching conclusions about companies. Most analysts just repeat what a company tells them. They're often more focused on protecting their relationships with management than on protecting the average investor from a potential loss. Robert Holstein, Holstein Capital Management. Part 2. Building the Case. Chapter 6. Cutting Through the Noise. Professional investors are an exceedingly competitive lot. Unsurprising given that their chosen field is one where the score delineating winners and losers can be tallied at every market close. But as results-driven as investors tend to be, the best money managers put equal emphasis on the process they follow for conducting research and making portfolio decisions. They have a clear understanding of the most important questions they want answered and how best to answer them. As we've stressed many times already, the areas of focus and methods of discovery can vary widely. Some investors put great emphasis on having macro views that inform their decisions, while others firmly reject that approach. Some consider time spent with management critical to their research process, while others consider it a waste of time. Some see industry specialization among analysts as a benefit, others see it as a detriment. But nearly all successful fundamental investors see their research and decision-making process as a primary source of a competitive advantage, and should be able to explain in detail why that's so. Equity strategist James Montier, now at Boston investment firm GMO, describes the importance of process this way. As much as I'd like to be able to control the outcomes, I can't. The only thing I can do is maximize the probability of getting a good outcome by following what I've defined as the right process. A good process doesn't negate bad outcomes or bad judgments. It just tries to mitigate them. It's like a pilot's pre-flight checklist. Pilots do the same thing thousands and thousands of times in their lives, but they still go through the physical checklist to eliminate what could be a catastrophic error if they try to circumvent it. Investors are well served by having similar types of checklists and sticking with them. The Baupost Group's Seth Klarman makes a similar point in a slightly different way. Money managers must keep firmly in mind that the only things they really can control are their investment philosophy, investment process, and the nature of their client base. Controlling your process is absolutely crucial to long-term investment success in any market environment. James Montier recently pointed out that when athletes were asked what went through their minds just before competing in the Beijing Olympics, the consistent response was a focus on process, not outcome. The same ought to be true for investors. Just as the best and most rigorously followed process will at times yield bad outcomes, the most arbitrary and slipshod process can periodically produce a good outcome as well. But if you're looking for a way to bet, the manager with the superior process is far more likely to win out over time. Second-level thinking. In describing a key goal of their research and analysis, top investors focus on the necessity of having, and of being able to justify, what hedge fund pioneer Michael Steinhardt termed a variant perception about any given stock they're looking to buy. What have you uncovered, and what do you believe that is at variance with what the market believes and is reflected in the share price? Without that, they say, how can you possibly expect to beat the market? First-level thinking is simplistic and superficial, and just about everyone can do it, a bad sign for anything involving an attempt at superiority. All the first-level thinker needs is an opinion about the future, as in, the outlook for the company is favorable, meaning the stock will go up. The second-level thinker takes many things into account. What is the range of likely future outcomes? Which outcome do I think will occur? What's the probability I'm right? What does the consensus think? How does my expectation differ from the consensus? How does the current price for the asset comport with the consensus view of the future and with mine? Is the consensus psychology incorporated into the price too bullish or bearish? What will happen to the asset's price if the consensus turns out to be right? And what if I'm right? The difference in workload between first-level and second-level thinking is clearly massive, and the number of people capable of the latter is tiny compared to the number of people capable of the former. Howard Marks, Oak Tree Capital. There's an old saying in poker that if you're not sure who the patsy is, you probably are. You cannot have an opinion about an investment unless you understand the consensus and can articulate why it's wrong. If you can't do that, you're most likely the patsy. If you think what everybody else thinks, it's already priced in. Think about betting on the Super Bowl. Why is Pittsburgh being a 4-point favorite the wrong line if you want to bet on Seattle? You may not have to know if you're betting for fun on Sunday, but you sure better know if you're making decisions with $8 billion of your client's money. John Jacobson, Highfields Capital. If you find a stock that you think is undervalued, but you're unable to identify how your insights into the companies differ from those the market is using to price the stock, it's probably not really undervalued. Steve Morrow, New South Capital. This may sound obvious, but we work very hard to understand the fundamentals of a business and to identify the key drivers behind a company's potential success or failure. We end up focusing on many of the factors you'd expect: competitive positioning, returns on capital, organic growth, etc., but always with an eye towards identifying the biggest differences between our view and the view of the market. Lee Ainsley, Maverick Capital. Why something is mispriced is too often ignored by value investors. The general thinking is that it doesn't really matter. If you're right that something is mispriced, it will eventually take care of itself. We think it matters because you can conceivably avoid a lot of pain waiting for truth to prevail if you have a good read on why it currently doesn't. Curtis McGwen, Ivory Capital. Macro versus micro. Prior to the 2008 financial crisis, it was rare for investors we interviewed to put much credence in applying informed macroeconomic views to buying stocks. Conventional value investing wisdom had been that trying to forecast GDP growth or interest rates or the level of the overall market was excessively difficult and therefore unhelpful in assessing the attractiveness of any given stock. The 2008 crisis, in which individual stocks' relative merits were overwhelmed by horrible macro news that took all share prices down more or less together, modified that conventional view somewhat. That's not at all to say everyone switched to a focus on macroeconomic expertise, but its relevance to the research and analytical process is now subject to much livelier debate. One conclusion I made from our 2008 and early 2009 experience being more unpleasant than I would have liked is that I needed to better incorporate my worldview into individual security selection, with the goal of trying to minimize future unpleasantness. We're focused on better connecting the dots between the overall economic environment and the opportunities or pitfalls facing individual businesses. In 2008, we were looking at trees and didn't see the forest. Chuck Ockrey, Ockrey Capital Management. Most of the time, investing with less regard for macroeconomic forecasts is the right approach, but in my experience there have been times when one or a handful of major factors, such as large waves of liquidity going in and going out, overwhelm traditional metrics of value to set market prices. In such times, ignoring those factors has proven to be dangerous. Mohammed El-Arian, PIMCO. We, like a lot of people, have been trained to be bottom-up stock pickers and not worry about the market. The fact is, however, that most of the risks we see today in our individual ideas are macro in nature. So, as stewards of capital, we ignore those risks at our peril. Informing yourself on macro issues is not really any different than the work you do to inform yourself about a company or an industry. You read, you talk to people, you learn from the companies you own, you subscribe to the best services. It clearly takes time and energy to do it right, but to do otherwise today strikes us as a big mistake. Brian Feltzen, Sheffield Asset Management. One element to our process I have added in recent years is what I call pest control. I grew up in the business with the basic assumption that I didn't need to worry much about macro issues as long as I had enough margin of safety from a cheap stock price. That's no longer a safe assumption, so we force ourselves to more fully assess the risks of political, economic, social, and technological changes that could derail our thesis. Jeffrey Bronchick, Cove Street Capital. In a market with all these potentially negative and serious macro factors, our gross and net exposures are likely to remain low. You don't want to be a sitting duck waiting for your fundamental catalysts to play out while all these macro factors might swing your stocks wildly, and in some cases, overwhelm any fundamental catalysts you're counting on. Curtis McGwen, Ivory Capital. I used to completely ignore the macro environment, but now I pay attention and try to have a basic view that informs how we look at everything. We're taking our cues on that from the companies and industries we research every day. That's more relevant to us than the transcript from the latest Federal Reserve meeting or some Bureau of Labor Statistics report. Ricky Sandler, Eminence Capital. If you're a hedge fund with the audacity to charge between 1% and 2% as a management fee and take 20% of the profits, your clients have the right to expect something more. One aspect of what I consider more is that when the market's overvalued, my clients expect me to figure it out and be hedged and out of harm's way. When the market's undervalued, they want me to be leveraged to the upside. We're not a slave to our market view, but the truth of the matter is that a rising tide does lift all boats, and a falling tide lowers them. Leon Cooperman, Omega Advisors. Virtually all studies show that about 60% of the return and volatility of the average common stock is determined by the movement in the aggregate stock market. So while we're bottom-up stock pickers, we think it's important to have a view of the economy and the overall market to help us determine which industries and sectors to emphasize. Stephen Einhorn, Omega Advisors. Making reasoned macro calls starts with having the best and longest time series data you can find. You may have to take some risks in terms of the quality of the data sources, but it amazes me how people are often more willing to act based on little or no data than to use data that is a challenge to assemble. Robert Schiller, Yale University. I do fall in the camp of investors who now believe that blissfully ignoring macroeconomic trends is a mistake. Paying attention to macro issues is still probably a waste of effort 95% of the time, but that other 5% can be very important. One of my efforts in this regard is to better understand what's going on in credit markets and to figure out what those markets might be signaling that the equity markets aren't. Zeke Ashton, Centaur Capital. We're bottom-up stock pickers, so the main reason we concern ourselves with the macro environment is to pressure test the companies we invest in. Using a nautical analogy, we're looking at the weather forecast to make sure our boat will be strong enough, not to pick the day to go sailing. Even our macro views stem largely from bottom-up work. We were interested in Fannie Mae in 2007, but first wanted to understand their credit risk better. We spoke with the ratings agencies and asked them what would happen if house prices fell. "You mean a Six Sigma event?" they asked. "No," I said, "just if prices fell 5 or 10%. They said, "That's Six Sigma." Well, if house prices going back to where they had been just 12 months earlier was considered Six Sigma by the ratings agencies, I thought we were in trouble. Boykin Curry, Eagle Capital. We're not macro people, but you cannot be investing other people's money without thinking about the state of the world, much of which is unsettling. Think about the U.S. government's debt level and what happens if interest rates increase. Think about housing values, the unemployment rate, and the price of gasoline and what that means for consumer purchasing power. What's going to happen in the Middle East? What's going to happen in Japan? What's going to happen with the U.S. dollar? There are an unusual number of serious things to worry about. When that's the case, that all makes its way into the portfolio by our assessing the impact of all these things could have on each company we own and fully understanding the downside. We also think in times like these, when there are so many imponderables out there, it's important to have a significant cash cushion in case something goes wrong. Dennis Delafield, Delafield Fund. We've always been dedicated bottom-up investors, fully believing that old line from Peter Lynch that if you spend 15 minutes a year studying the economy, you've wasted 10. While I'm not prepared to renounce that position, I do believe we need to do our bottom-up work with a greater appreciation for what's going on in the world. Jim Rummel, Rummel Asset Management. It's important not to get too caught up in the macroeconomic or political currents and just focus on the fundamentals of individual businesses. Bigger issues obviously matter, but they should be just a part of the many inputs you look at in assessing the quality of the business, its prospects, and what you think it's worth. It doesn't matter how well you handicap the next presidential election if you can't discern a good business from a bad one. David Harrow, Harris Associates. More people are saying, everything's macro, you've got to think in terms of risk on, risk off. I think that's a really nutty thing. I just don't believe you can be effective in trying to get those decisions right in the short term. Howard Marks, Oak Tree Capital. I would argue that if macro factors are too big a detriment in your appraisal of a company's intrinsic value, you should just sit that out. Given all the issues in Europe, for example, we don't have to bet on European consumer companies whose fortunes are closely tied to how the debt crisis there plays out. In the U.S., we don't have to bet on healthcare stocks whose futures depend on macro healthcare legislation, or the financial strength of government entities that pay a lot of the bills. We should just move on to where the micro is driving value. Staley Cates, Southeastern Asset Management. In general, we build the portfolio one stock at a time and don't really go offensive or defensive based on what we think might happen in the macro environment. We'll always have things in the portfolio that will do better when times are tough or when times are good, but they tend to balance each other out. When you focus as much as we do on operating turnarounds, those kinds of stocks, if you're right, should do relatively well regardless of how healthy the economy is. Mariko Gordon, Daruma Capital Management. While it is always tempting to try to time the market and wait for the bottom to be reached, as if it would be obvious when it arrived, such a strategy has proven over the years to be deeply flawed. Historically, little volume transacts at the bottom or on the way back up, and competition from other buyers will be much greater when the markets settle down and the economy begins to recover. Moreover, the price recovery from a bottom can be very swift. Therefore, an investor should put money to work amidst the throes of a bear market, appreciating that things will likely get worse before they get better. Seth Klarman, The Baupost Group. I gave a speech recently in which I borrowed Oak Tree Capital Chairman Howard Marks's concept of the I know versus the I don't know investor. The I know investor thinks knowledge of the future direction of economies, interest rates, and markets is essential for investment success, and is confident not only that he can have such knowledge, but that he'll have it first as well. These are people who are quite popular at dinner parties. The I don't know investor doesn't believe that you need to know the future, or even that you can, so spends most of his or her time on how big the margin of safety is, and in assessing what risks can result in the permanent impairment of capital. This tends to be a contrarian lot, and they aren't hugely popular at dinner parties. James Montier, GMO. We mostly have nothing to say about the market overall. Given that we maintain a disciplined range of net exposure, whether we get the market right or wrong doesn't make that much difference. If our net exposure is at 40% rather than 60%, and the market makes a 10% move, that's a 200 basis point impact. That's not nothing, but it has far less impact on how we do than individual stock selection. Adam Weiss, Scout Capital. In the end, I fall back on the fact that our process is meant to identify undervalued companies on an absolute basis, using conservative assumptions. If I can find them, I'll buy them. If I can't, I'll hold the cash until I can. That process is meant to work in any macro environment, and so far, it's held up pretty well. Eric Cinnamond, Intrepid Capital. I've always told people I have no idea what the market's going to do or when returns will appear in the portfolio. I don't think either of those is predictable. The best we can do today is to focus on companies with balance sheets to weather a credit-constrained world, business models that will be around for years to come, and valuations that are cheap enough to make the wait for recovery worthwhile. That's what we can control. The rest of it takes care of itself. Andrew Jones, North Star Partners. The first lesson, post-financial crisis, was that bottoms-up fundamental company analysis still matters quite a bit, and that ignoring the experience of Graham, Buffett, and our 35 years to become macro-driven generals fighting the last war would have probably left us on the sidelines at exactly the wrong time. Parking ourselves in cash in early 2009 to wait for clear signs the misery was over would have caused us to miss the best purchase point for equities in my lifetime. Staley Cates, Southeastern Asset Management. There's no question that getting the macro picture right is hugely valuable. I just wish I were capable of doing it. When it comes to macro events, you can either predict or react. I've proven time and again that my crystal ball is horrible, so my focus has to be on reacting to extremes in individual securities by selling at high valuations and buying at low valuations. Bruce Berkowitz, Fairholme Capital. Many of our peers seem to have concluded that bottom-up investing isn't good enough anymore, an opinion we don't share because the assumption is that it's easy to have a non-consensus macro view that adds value. So many of the macro overlays you hear today talk about Europe having trouble restructuring its debt and the U.S. economy growing slower than it has historically. Could you be any more consensus than that? With the 5 to 7 year time horizon we think about, you're usually better off thinking that things are going to be sort of normal, as opposed to having a strong conviction about what the economy is going to look like that overrides all of your bottom-up work. Our view today that things normalize over 5 to 7 years might be as anti-consensus as most of the macro overlays out there. Bill Nygren, Harris Associates. I talk to investors who have just been in New York and who want to know my macro view and whether I think Japan is going to be a vortex that pulls the whole global economy down with it. Their eyes glaze over when I start talking instead about C.R. Bard's Foley catheters or the new bank fusion software at Mises. But that's what matters to us. Our goal is to find earning streams that are defensible in good times and bad, and that also demonstrate secular growth. It's frankly an advantage to not get overly distracted by macroeconomic concerns, which can make it hard to pull the trigger on a great business when the opportunity presents itself. Jeffrey Ubben, Value Act Capital. Business first. It's rare in speaking with accomplished investors that they say their initial effort in assessing an investment's viability is how cheap the stock is. That's obviously important in the end, but given that any credible assessment of a company's value relies in large part on judging the prospects for its business, most investors focus first on understanding the dynamics of the company's competitive environment, the secular trends affecting the industries in which it competes, and the impact all of the above has on the sustainability and profitability of its business model. As GAMCO investors Mario Gabelli puts it, simply, only after you understand the business can you understand the stock. The biggest lesson learned from my father was that investing was all about business and people. He'd talk about McDonald's versus Burger King or the rise of Nike or how Steve Jobs started Apple, all in a way that was very interesting for a kid. There was nothing about P/E ratios or market caps, things he figured we could learn later. He wanted us to understand the essence of business and what made a business successful. Christopher Davis, Davis Advisors. One of the best lessons I learned early on was to look at companies as companies first, to understand what they want to achieve and the likelihood they can achieve it. People too often focus on stocks first and think they can generate an edge in how they're looking at valuation. In the end, static valuation is relatively efficient, and it's what companies do that drives their futures. Oliver Kratz, Deutsche Asset Management. Before I even look at a financial statement, I try to find out as much as I can about the history of the company, to understand how it has arrived at its current predicament. If we're looking at it, it's usually a predicament. The internet is very good for this type of research. I'm trying to find evidence of similar issues in the past and what happened, to help judge whether current problems are controllable and rectifiable. If a company loses dominant market share in a business, for example, in my experience it almost never recovers that share. If it retains dominant share but lets its costs get out of control, the probability of that problem being solved is very high. I want to know whatever I can to help me make those distinctions. Murray Stahl, Horizon Asset Management. We focus on companies with long competitive advantage periods, which puts a premium on our truly understanding the business dynamics over time. As a result, features of businesses we're tempted by typically include stable market shares, stable margins, pricing power, and long data series, so we can evaluate how the business has performed through good times and bad. James Crichton, Scout Capital. Our research is very focused on the context in which a company is operating and on understanding why the valuation is so low. If you're buying a house, you don't ask your real estate broker to blindfold you and take you to the cheapest house in town and just look at it from the inside. You have to stick your head out the window and walk around the neighborhood to really understand what it's worth. So when we look at banks, we want to know the leverage ratios for consumers in their primary markets. When we look at cement companies, we want to know where construction activity is historically relative to GDP in the relevant markets and what import prices are. Just buying cheap stocks without paying enough attention to those contextual issues can get value investors into trouble. Dan O'Keefe, Artisan Partners. We focus on industry structure. We like concentrated industries with 2 or 3 primary players. As value investors, we are typically buying the underperformer. There are issues to fix, but the customers are rooting for you, and the leading competitor, with high margins and a high stock price, is probably not going to go for the jugular. Jeffrey Ubben, Value Act Capital. The 3 primary drivers for a stock are the macro factors that influence the broader market, the dynamics of the industry in which the company participates, and the specific prospects for the company itself. We don't think we're particularly adept at predicting the broader market, but we're quite comfortable first analyzing an industry or sub-industry trend and then diving deeper into company-specific issues. This middle-down approach, as we call it, keeps us from putting so much importance on a cheap valuation, a great company-specific story, or a particularly appealing management that we miss a broader industry trend that makes all that irrelevant. As Warren Buffett has said, when management with a great reputation takes over an industry with a bad one, it's the industry that usually comes out with its reputation intact. We often find multiple ideas supported by common viewpoints. In general, we think it's easier to hit the side of a barn than one single spot on the barn. Michael Karsh, Karsh Capital. We spend a lot of time trying to figure out how competitors would attack the business of the company we're interested in. The harder that is, the more interested we are. We try to avoid markets perceived to be so attractive that capital could start pouring in at any time. Mario Sabelli, Marathon Partners. There are usually only a few things you have to get right about a company for it to be a successful investment. What are the key drivers of the business and how are they changing? What is the company doing to position itself for that future, and what is it doing to operate more efficiently and effectively? How are they redeploying capital? Our view is that if you can get 85% of the way there by answering the big questions, don't waste your time on the last 15% because the marginal utility isn't worth it. Steve Morrow, New South Capital. The key questions we want to answer focus on assessing the basic attributes that, to us, make an interesting stock. Does the company generate structural free cash flows? Is there some element of defensiveness in the business model that will hold off competitors from coming in and disrupting the economics? Is there some element of secular or company-specific growth potential? How capable is management? What is the catalyst to value creation? Matthew Burler, Osterweiss Capital Management. My daughter was 6 or 7, so rather than try to explain money management and the stock market, I said I'd tell her how I spent my time. I told her that half the time I read things like newspapers and magazines, and half the time I spent talking with my colleagues. She said, "That's not work," but that's what I do. It's very common to drown in the details or be attracted to complexity, but what's most important to me is to know what 3, 4, or 5 major characteristics of the business really matter. We have a great team of analysts who find the ideas and do the investigative work, and I see my job primarily as asking the right questions and focusing the analysis in order to make a decision. Jean-Marie Eviard, First Eagle Funds. What quality means. While not all value investors emphasize the quality of the business in which they invest, many follow Warren Buffett's lead in their preference for a great business at a fair price over a fair business at a great price. Those who emphasize quality also have a very refined sense of what they believe quality means when it comes to companies and their businesses. Our ideal investments are in franchise businesses, the term we use to signify a right, a license, or a privilege that confers an economic advantage that will permit the company to earn above-average returns on capital over long periods of time. That generally manifests itself in some form of competitive barrier to entry, from brand strength, intellectual property, the regulatory environment, or scale. It also typically means the business is somewhat shielded from unpredictable macroeconomic forces, and even better, that it should grow in good times and bad. Companies with these characteristics are winners, and they tend to stay winners. Peter Keefe, Avenir Corp. We start from the premise that we want to invest in great businesses that share common characteristics. They provide essential products and services, meaning they are more have-to-have than nice-to-have. They have very satisfied and loyal customers. They have leadership positions and sustainable competitive advantages in attractive industries and markets. Financially, they earn high returns on capital, certainly above their cost of capital, and generate high after-tax free cash flow that can be used to invest, make acquisitions, pay down debt, buy back stock, or pay dividends. Timothy Harch, Brown Brothers Harriman. We like simple, predictable, free cash flow generative, resilient, and sustainable businesses with strong profit growth opportunities and/or scarcity value. The type of business Warren Buffett would say has a moat around it. We've done almost nothing in energy or other cyclical businesses. We avoid healthcare because of all the regulatory uncertainty. We've done nothing active in financial services except on the short side with MBIA. When you're putting 8%, 12%, or 15% of your money in something, it's not a day trade. You have to focus first and foremost on high-quality businesses that can't blow up and should grow in value over time. William Ackman, Pershing Square Capital Management. What makes a high-quality business? At a basic level, the product or service being sold is critical to customers but is only a small part of their cost structure, and the customer relationship tends to be sticky and recurring. Generally, we end up in intellectual property-based businesses that can price off of a value add rather than some sort of cost basis. Jeffrey Ubben, Value Act Capital. We're looking for businesses with low capital intensity, the ability to generate high levels of free cash flow, and a privileged business model that enables the company to produce excess capital. We want the financial and business models to be transparent. In terms of competitive dynamics, we want to understand the value of the company's product or service to customers and the strength of its competitive moat. From an industry perspective, we ideally want to see long-term sustainable growth and secular tailwinds. James Crichton, Scout Capital. My favorite ideas tend to be companies that generate free cash flow, not cheap cyclicals or stocks trading at discounts to book. One big advantage of investing in companies generating free cash flow is that you can be more patient because the intrinsic value tends to grow while you own it. They're adding cash to the balance sheet, paying down debt, buying back their stock. The stock price may not perform for a time, but the intrinsic value growth will eventually be reflected in the market price. You're getting paid to wait. Andrew Jones, North Star Partners. High-return businesses have something special which allows them to earn above-average rates on employed capital. That may be intellectual property, scale economies, a regulatory advantage, high customer switching costs, or some sort of network effect. We want to see evidence the business model produces unusual returns, to understand why, and to believe that's likely to continue. Part of that is a function of the opportunity yet to be realized. We're always asking, how wide and how long is the runway? Chuck Ockrey, Ockrey Capital Management. An area on which we spend a lot of effort is to define how big the runway of opportunity is in the business. We're not looking for short-term or arbitrage opportunities, but cases where we can see a reasonable possibility of a huge upside, which we're not paying for. Robert Jaffe, Force Capital Management. The most important thing that I figured out early on was the benefit of investing in turnarounds of focusing on companies that operate in growing markets. If a company has market growth as a tailwind, it's quite a bit easier for management to execute an operational turnaround. Kevin O'Boyle, Presidio Fund. It takes a lot to kill a strong established franchise, even if a company loses its way. Think IBM, think McDonald's. The right management can make all the difference in whether the business comes back. The strength of the franchise and the quality of management are what I spend most of my time on. Lloyd Connor, Connor Capital. We're not usually looking for the scruffy cyclical or turnaround story, but for businesses with high market shares in their principal product or service lines, with long product cycles but short customer repurchase cycles, and with relatively low capital requirements that allow the company to generate high cash returns on tangible assets while growing. We've always considered businesses requiring enormous amounts of capital for fixed assets, especially when they're economically sensitive, to be at a big disadvantage. Donald Yachtman, Yachtman Asset Management. One important aspect of business quality is how successful it will be in a less buoyant economic period. Can they cut costs? Can they take market share? Will their balance sheet be an asset? The answer to those questions can make a huge difference in the viability of any investment. David Samra, Artisan Partners. Since we often suggest that companies refocus on their core business, the majority of our research time is spent on determining the health and sustainability of that business. We need to fully stress test our assumptions on the core business. That's where something could go wrong, if it were going to go wrong. Peter Feld, Starboard Value. In companies earning abnormal returns, there's something unique going on, and we want to understand what it is, why it exists, and whether it's sustainable. We're trying to find businesses that have great moats, which translates into great returns on capital. Moats are fairly rare but come from a variety of things, such as intellectual property, scale economies, a regulatory advantage, high customer switching costs, or some sort of network effect. True moats give you more confidence in projecting future performance. Chuck Ockrey, Ockrey Capital Management. To us, the definition of a good business is if you can specifically identify reasons why it should be able to earn a return in excess of its cost of capital. It could be anything, a competitive cost position, a franchise brand, an installed base of business, unique technology, some reason to believe that even if the current management fails to restore earnings, somebody else would want to try, say an acquirer of the assets, or the board replacing management with other management, or even the same management trying another plan, because it's worth trying and you can specifically understand why it's worth trying. Richard Pazina, Pazina Investment Management. Crunching the numbers. While it's less common than you might think for successful investors to hold accounting-related degrees and credentials, that is not at all to say they're uninformed when it comes to the nuts and bolts of income statements, balance sheets, and cash flow statements. In fact, most top managers stress the importance of looking beyond the stated accounting numbers to draw insight that might give them an edge in analyzing a company and its stock. The goal with all our accounting adjustments is to arrive at numbers that best reflect true economic reality. We'll increase earnings if depreciation charges are overstated, for example, which is often the case in countries where the tax code tends to govern reporting decisions. We'll decrease earnings if depreciation charges are understated, as often happens in countries like the United States, where earnings per share and/or share prices matter greatly to the compensation of the top executives. We look at everything: pension liabilities, environmental liabilities, restructuring charges, etc., and make adjustments to arrive at the true results. Sometimes those adjustments can make something much more attractive than the market seems to recognize. Charles Dulardemel, International Value Advisors. We spend a lot of time accounting for the inefficiencies of generally accepted accounting principles, which are most prominent in longer-term assets. That could be land held on the books at cost, which over time is worth something very different than cost. Any asset that can be depreciated is potentially valued at something materially different than the current market value. When a company buys equipment or builds a building, it sets depreciation schedules based on useful lives and other accounting conventions. But those schedules know nothing about the future supply and demand for that equipment, or the occupancy levels and cap rates for the building. Over time, as that asset is depreciated, there can be major discrepancies between book value and true market value. Ari Levy, Lakeview Investment Group. We primarily focus on understanding the unit economics of the business. In a retailer, for example, we have to understand how one store works. What are the capital requirements and maintenance spending? How does the lease work? How does the cash flow build? This is the way managers in the field think, and we think this approach helps us best understand the drivers of the business. When we choose to pick a fight with the market, as we call it when we buy something, it's usually because of the work we do at this level. Wall Street is very top-down, say, in looking at how much revenue at what overall margin equals how much EBITDA. We work from the bottom up, which we hope helps us understand better than the market how returns on capital can be improved. Another advantage of knowing the unit economics is that we think it allows us to identify problems early. When we see a deterioration in unit-level returns on capital, that can give us a chance to respond before it's fully reported in the P&L. Joe Wolf, RS Investments. Our most important focus is on understanding a business's return on invested capital, and, perhaps more importantly, its return on incremental invested capital, ROIC, which I've learned to appreciate more and more over the past 25 years. We scrub the financials to get a reliable picture of the company's historical full-cycle ROIC and want to see it significantly ahead of its weighted average cost of capital, which means the company is creating shareholder value. If a bad acquisition has been written off, for example, we'll evaluate whether some or all of that write-off should be added back to the capital base in assessing the return on capital. We're not just looking backwards, but also want to see that prospective returns, based on our estimates of earnings and the investments necessary to generate those earnings, are going to be attractive. Pat English, Fiduciary Management Incorporated. We analyze receivables and inventories to determine changes in each relative to changes in sales. Inventories and receivables increasing faster than sales can be early warning signs of future slowdowns. Inventories building in the right places, like raw materials and work in process, can be signs of future strength. Robert Olstein, Olstein Capital Management. One exercise we go through on all our most interesting ideas is what we call balance sheet optimization. It's our term for debt recap. What can management do, fully under its control, with the capital structure to create value? Use Microsoft as an example. It has $60 billion of cash on hand, very little debt, and throws off something like $30 billion in free cash flow per year. The equity has been trading at 8 times to 10 times earnings, and the company can issue debt at less than 3.5%. So there's a huge difference between the cost of debt and the cost of equity. As an exercise, what would happen if it went to a net $60 billion debt position? Given the free cash flow, that's still a modest capital structure. They take the $120 billion in cash proceeds and buy back a significant amount of their equity. With a lowered cost of capital and shares outstanding cut in half, if we run that through our cash flow model, assuming no growth, we come up with a share value in the low to mid-40s versus around $28 today. We look at this as our downside protection and also as a way to distinguish our analysis. It's difficult to outpredict the street consistently on Microsoft's growth over the next 5 years, but very few analysts focus on value creation through the capital structure, so it can provide us with a different perspective on how to value the stock. Stephen Goddard, The London Company. The detail matters. It's one thing to say incremental margins are X%, but we need to show all the detail used on things like pricing and fixed and variable costs to justify why that conclusion is accurate. James Crichton, Scout Capital. One reason we can find opportunities is that the market is pretty good at forecasting top-line growth, but then it gets a bit fuzzier as you go from sales growth to what earnings growth is going to be, and then most research gets really fuzzy when it comes to things like how much capital will be needed to support growth, where the capital will come from, and how much excess cash will be generated, all of which feeds into ultimate business value. Bill Nygren, Harris Associates. I think the number one variable in the investing equation that Wall Street overlooks is margin leverage. Most investors focus on leverage from sales growth, which is relatively easy to figure out, and everybody looks at that. But in the great organic growth stories, such as Starbucks, Home Depot, Walmart, and Bed Bath & Beyond, a lot of the share price upside has come from these companies increasing operating and net margins as they grow. If you get this type of company early enough in the story, which is what I try to do, you will get a tremendous amount of appreciation from both sales and margin growth. That's the most overlooked source of big money gains I can think of. Arnie Alson, Alson Capital Management. A predilection of mine that has caused problems at times is to favor stories or companies that are complicated or esoteric. The classic example for me was Novell, the software company, which provided probably the most painful investing experience we've had during my tenure here. It's a long story, but we bought the stock many years ago because it was very cheap on an enterprise value basis, and it had a product called Network Directory that I thought was a real game changer. The problem was that Novell had so discredited itself in the market through previous missteps that the target customers weren't willing to buy anything from them. I was so enamored with Network Directory's product specifications that I missed the forest from the trees on whether they could actually sell it. Brian Barish, Cambiar Investors. I should point out that we can go too far in our zeal to crunch numbers. We once missed a big run-up in Black & Decker because I docked them for some unfunded pension liabilities that took them something like 2% out of our buy range. We loved the company and loved the products and thought they were doing all the right things to turn around their business. So we missed a double by paying so much attention to detail that we missed the big picture. Robert Olstein, Olstein Capital Management. What could go wrong? As they analyze industries, business models, and financial statements, value investors, in particular, place considerable emphasis on what can go wrong and the potential impacts those negative turns of event could have. They frequently repeat phrases such as, "It's important to look down first before looking up," or "We're focused first on return of capital rather than return on capital." They take seriously the analysis of their mistakes, with the obvious goal of not repeating them. This obsession with the downside reflects a mindset captured nicely by Gotham Capital's Joel Greenblatt, who says, "If you don't lose money, most of the remaining alternatives are good ones." If you look at sports history, the champions have usually been the best defensive teams, not those with the most exciting offenses. I went to school at Michigan State when Woody Hayes was the football coach at Ohio State. Woody's philosophy was that a 3 yards in a cloud of dust offense was all you needed if you played great defense. We lost to him every year. I've always believed that above-average, long-term performance in the stock market is highly correlated with avoiding serious errors, so I always focus on what can go wrong first. I want to know the downside risk potential before looking at the upside. While it isn't in real life, paranoia can be a virtue in the investment business. Robert Olstein, Olstein Capital Management. We are big fans of fear, and in investing, it is clearly better to be scared than sorry. Seth Klarman, The Baupost Group. You're a product of your experience, so the fact that I came of age as an investor in the 1970s has basically made me scared of everything. I've found that abject fear and sound analysis can be a very healthy combination for an investor. Susan Byrne, Westwood Management. The very first thing we do when we start to analyze a company is to ask ourselves how far the stock price would fall if we were wrong. It's not some back-of-the-envelope calculation, but a full assessment looking at liquidation asset values and stressing the business model and valuation levels under any number of bad scenarios. If the downside is more than 30% from today's price, it's unlikely we'll invest, regardless of the upside potential. If we can't establish a concrete downside number, which probably means it isn't far from 100%, we absolutely won't buy the stock. Going through this first sets the tone we want to set in our research. Rather than start out looking to convince ourselves why we should buy something, we start out trying to prove why we shouldn't buy it. We try to keep that level of skepticism alive throughout the process. Reagan Steinke, Westwood Management. We believe in the power of compounding, and the simple math is that you can't compound very well if you suffer too much on the downside. I don't understand why people can go on at length about why this or that company will grow and prosper, often spend little time on what can go wrong and the impact it could have on the share price. It's not as if defining the downside is more difficult. It's probably easier than estimating the upside. Tom Perkins, Perkins Investment Management. Top of mind for us in identifying potential investments is a notion borrowed from Warren Buffett that we call the 5-year rule. If we hold a stock and the market closes for 5 years, will we sleep well at night with it in the portfolio? We find answering that question is a great line of defense against big mistakes. If you find yourself needing regular market feedback to be comfortable with your estimate of value, maybe it doesn't really have the margin of safety you think it does. Michael Kovitz, Kovitz Investment Group. We always ask before buying whether we'd be comfortable putting the stock in a lockbox for 5 years and not touching it. If we're not, we shouldn't buy it. That's not an argument for putting your head in the sand, but we think you need that level of confidence in the business to think most clearly when things go temporarily awry and clients are questioning you. Pat English, Fiduciary Management Incorporated. You can't take a long-term view without confidence that the company's financial condition will allow it to meet out-of-left-field macro or micro challenges. There's an old saying that the balance sheet doesn't matter until it's all that matters, so we want to be ahead of that. That's particularly important in smaller companies, which are generally built on more fragile foundations than big, diversified ones. We measure leverage fairly broadly by looking at the ratio of assets to stockholders' equity. This allows us to see risk items that might not otherwise show up if we were primarily focused on long-term debt, like higher than usual levels of receivables or bulging inventories or increasing short-term bank lines of credit that may have a way of running into more permanent debt. Our general rule of thumb for non-financials is to look for a 2-to-1 ratio of assets to stockholders' equity, which we consider a reasonable margin of safety. Whitney George, Royce & Associates. If you've looked at tens of thousands of balance sheets as I have, you know what to look for in each situation. Generally, though, we look at debt-to-equity ratios, liquidity, depreciation rates, accounting practices, pension and healthcare liabilities, and hidden assets and liabilities. The overriding question is, if something goes wrong, what's our protection? Ed Wachenheim, Greenhaven Associates. One of my more common mistakes would be ignoring the potential impact of leverage. I know the effect goes both ways, but say you do a sum-of-the-parts analysis and think the assets of a company are worth $100. If the company has $70 of debt, overstating the asset value by only $10 makes the equity value go from $30 to $20. In the grand scheme of things, being 10% off isn't that big a mistake, but when there's heavy leverage, it is. Jean-Marie Eviard, First Eagle Funds. To some extent, balance sheet risk is a character issue for us. The CEO whose company has a great balance sheet probably isn't going to make the big, dumb acquisition that will kill the company. He's probably not the guy throwing $2 million birthday parties for his third wife at company expense. Other investors like the leverage that having debt gives you on the upside, but we generally try to look down before we look up. Leverage doesn't look so great from that perspective. James Clark, Clark Bennett, LLC. Value investors' advantage usually comes from having a time horizon longer than most investors, over which the issues that might be making something cheap either cycle away or are fixed. In companies with strong financial positions, it can take longer than you think for things to work out, but you always get to come back and play another day. If you start with a bad balance sheet, the clock is ticking loudly right out of the chute, and you may never get the chance to prove how smart your long-term analysis really is. J. Kaplan, Royce & Associates. One thing we are very conscious of is the degree of leverage in a business. That can be financial leverage, which is reflected on the balance sheet. It can be operational leverage, where you look at how much of the cost base is fixed or variable. It can also be the degree of leverage to a particular industry or geography. In general, I'm uncomfortable with companies that are vulnerable to more than one of those kinds of leverage going against them at the same time. A cyclical business that has a lot of fixed costs, for example, should not have a lot of financial leverage or be too levered to one geography or industry. If things go the wrong way, management has its hands tied in trying to get out of trouble. This is a big reason we rarely find opportunity in more commodity-type businesses. David Harrow, Harris Associates. What we try to do with each potential investment is mark to market the assets and liabilities that have been reported on the balance sheet using generally accepted accounting principles. The underlying goal is to determine what the company would be worth if the assets were sold and the liabilities were paid off, providing us with a direct assessment of downside protection. Matthew Swain, Advisory Research Incorporated. The most direct influence on my strategy was my time working for Advisory Research, where the first emphasis is on marking assets and liabilities to market and determining the true net asset value supporting any potential investment. But behind that is a great deal of empirical research from people like Graham and Dodd, Roger Ibbotson and Fama and French, showing the long-term outperformance of value strategies focused on smaller cap companies that trade cheaply versus book value. The idea that as a starting point as an investor you look to pay no more, and ideally a lot less, than what you could realize if you sold all the assets and paid back all the liabilities has always been a powerful concept to me. Ari Levy, Lakeview Investment Group. We're probably more focused than the typical equity investor on staying power. Spreadsheets make everything look linear and controlled, but the real world oscillates, overshoots, collapses, and rebounds. A company with operational and financial flexibility, what we mean by staying power, is able to exercise options that are quite valuable at different points in the cycle. Without the firm handle on that flexibility that credit analysis provides, we'd argue you can't fully understand the wealth creation process as an equity investor. Mitchell Julis, Canyon Capital. MBAs learn all about optimizing capital structures, but I've been quite content sticking with companies that have extra safe balance sheets. I'll trade return on equity for safety any day. Jim Rommel, Rommel Asset Management. One general defense against value traps is to by and large avoid product cycle businesses. You can have faith that Nokia gets its act together in smartphones, or that Motorola returns to prominence in handsets, or that the latest device from Nintendo is a big hit, but we think that's very tricky. For a company caught in the headwind of a business cycle, we can make assumptions about recovery that we consider to be well-founded. We believe we're much less able to make similar assumptions about future product cycles. We're also leery of industries with excess capacity, independent of the business cycle. We're being very careful today in the automobile industry, for example, where there's still a lot of excess capacity and stepped-up competition is coming from China and elsewhere in Asia. Sarah Ketterer, Causeway Capital. I do tend to stay away from companies overly dependent on raising capital and the good opinion of the securities markets. Mark Twain used to say he was a good writer because he could remember everything, whether it happened or not. I'm leery of situations where management has too much temptation to report great earnings, whether they really happened or not. Thomas Gaynor, Markel Corp. Over the years, we have also become very leery, based on experience, of companies that need to raise capital in order to survive and prosper. It's not a good thing to be vulnerable to the whims of the capital markets, which can close rapidly and surprisingly. Jeffrey Tannenbaum, Fir Tree Partners. I've learned from experience to avoid acquisition-driven stories during the actual acquisition growth phase. Big problems always come of that. Jeffrey Ubben, Value Act Capital. The biggest mistakes we ever made involved a few investments in highly acquisitive companies that had balance sheet leverage. The big lesson is that when you mix financial risk, in the form of leverage, with operating risk, from having to integrate acquisitions, you compound the overall risk dramatically. If we come across a levered acquisitive company today, we're most likely to short it, hedge it, or pass on it. Jeffrey Tannenbaum, Fir Tree Partners. We've made mistakes in recent years investing in secularly challenged businesses, including newspapers, yellow page publishers, printing companies, and bookstores. The pace of change has accelerated in many of these types of businesses, and it's proven challenging for us to stay ahead of that. We've essentially concluded that the simplest way to avoid mistakes in secularly challenged industries is to just not invest in them. Eugene Fox, Cardinal Capital. We're very unlikely to make the bet that a secular decline in an industry or that a company just won't be as bad as the market expects. You can make tempting valuation arguments at certain points for businesses with secular headwinds, but modeling the trajectory of decline is very difficult. In the late 1990s, if you were first starting to model the decline of consumer photo film for Kodak, you'd likely assumed a slow, single-digit annual percentage decline over time. That's what happened for a few years, but then it started declining by 20, 30, 40% per year, which had a large impact on profitability. We've also found in these types of companies that the risk of misallocation of capital is high. Management may have a lot of free cash flow at their disposal. They're anxiously looking for ways to grow, and they often end up paying too much for acquisitions when they find them. Kanan Coleman, Invesco. A bubble is a logical impossibility when people are investing on a premise that not only won't happen, it can't happen. The tech bubble in 2000 wasn't because stock prices were high. It was because stock prices incorporated the belief that many companies in the same industry were all going to have 20% market shares and high margins. That can't happen, so you better recognize it when that's the expectation. Murray Stahl, Horizon Asset Management. I can't tell you how many times I heard during the internet bubble, "You just don't get it." I'd say things like, "Let's compare Kennametal to Cisco. I buy Kennametal, and every year it makes 25% more money. Yes, I know the market is telling you it doesn't want to put a high multiple on it, but I still have that money at the end of the year, and I'll have more money at the end of the next year. Why wouldn't I want to get that return?" And then I'd say, "Let's compare that to Cisco. Cisco's market cap is $500 billion. Say you're happy with a 15% return. So Cisco needs to make $75 billion for you to be happy. They're making $1 billion. Not in your wildest dream can they get to $75 billion. The size of the industry doesn't support it. Nothing supports it." But people would still say, "You just don't get it." And I'd finally say, "You're right. I just don't get it." Richard Pazina, Pazina Investment Management. One element we've added to the tail end of our analytical process in recent years is to consider scenarios that could send the stock down 30% or more, and we would not want to add substantially to our position. Common examples would be things like the loss of a giant customer or market incursions from a powerful competitor. Given the outsized positions we take, we want in a disciplined way to contemplate those scenarios up front and pass on the investment if they're even somewhat likely. Kian Ghazi, Hawkshaw Capital. One lesson reinforced by the financial crisis is that if you own common stocks, they will periodically go down 50%. We've heard Warren Buffett and Charlie Munger talk about that, and I've reminded my clients of it from time to time, but I'd have to say it wasn't particularly top of mind before the trouble hit. When making bets on what will happen, it's very important to consider all that can happen. Chuck Ockrey, Ockrey Capital Management. It's hard to get away from truisms and cliches, but things that appear too good to be true, investments or otherwise, usually are. Thomas Gaynor, Markel Corp. From the top. While they won't always admit it, most investors hold a special place in their hearts for successful and honest corporate managers. That's primarily driven by the significant role strong management can play in increasing share value, the surest way into an investor's heart, but it also reflects respect for the difficult job top managers have. As the Fairholme Fund's Bruce Berkowitz says of the best CEOs, "These are people who are great operators and managers with excellent people skills, not qualities value investors are generally known for." Investors similarly hold a special enmity for corrupt or inept management, who waste shareholders' money, line their own pockets at the expense of the company's true owners, or otherwise breach the trust put in them. Investors face a variety of risks, which we can more or less address in how we conduct our analysis and make our investment choices, says Thomas Russo of Gardner Russo & Gardner. But the risk that can really set you back, and that is more difficult to control, is if you have a management that takes these great cash flows and wastes them, or expropriates them more for their own benefit than for the benefit of the company. That, I think, is the biggest risk public equity owners face. Researching people may be one of the more difficult tasks investors face, requiring more subjective judgment than needed when parsing a balance sheet, for instance. While some top investors downplay the importance they put on assessing management capability, a greater number spend considerable time and use a variety of methods to learn about top managers' track records, their skills, their thought processes, and their motivations. How important is management? Warren Buffett has famously noted when talking about management that, "I try to buy stock in businesses that are so wonderful that an idiot can run them, because sooner or later one will." This says more about Buffett's emphasis on business quality and sustainability than his disinterest in top managers' talent. In fact, his own management style in running Berkshire Hathaway puts primary emphasis on identifying first-class managers to run his businesses and getting out of their way and letting them do it. This emphasis on knowing as much as possible about top managers' skills, aspirations, and motivations in running their companies is widely shared among the best investors. Making judgments about management is important to us and something I think value managers tend to underweight. You can analyze something statistically, but if you expect to own it for 10 years, management is going to make thousands of decisions you can't predict and may never even know about, which collectively make earnings compound at a rate more or less than they would have otherwise. Those things can add up over time to the difference between a great performer and an also-ran. Boykin Curry, Eagle Capital. Julian Robertson of Tiger Management was maniacal on the importance of management. Have you done your work on management? Yes, sir. Where did the CFO go to college? I thought you did your work? He wanted you to know everything there was to know about the people running the companies you invested in. Lee Ainsley, Maverick Capital. We've looked carefully at why we so often sell investments too early. People tend to give you a pass on that, saying you invested in the safest part of the profit cycle, but I have to say people have made a lot of money buying stocks from me. Over an investment career, that's not a good thing. What I discovered is that the investments that have done much better than I expected after I sold are consistently those in superior businesses and/or with superior managements. That's why we now spend so much time analyzing management's prior actions and the results in creating shareholder value. Ken Schubin-Stein, Spencer Capital. I'm at a stage in my career where I'd say human behavior is the most important determinant of a business's long-term success. I don't care how smart an analyst you are, you can't really know what's going on inside a business. We want to invest not only in highly capable managers, but also those with clear track records of integrity and acting in shareholders' best interest. Chuck Ockrey, Ockrey Capital Management. Our entire investment team has had training in interview techniques and lie detection. I don't think you can spend too much effort trying to understand the quality of management. At the end of the day, it's the most important investment criterion. I've learned over time that great management teams deliver positive surprises and bad ones deliver negative surprises. What's important? Integrity, intelligence, competitive drive, and a proven desire to create value for all shareholders. We just find the odds of success to be too low in situations where we have to fight to get management to work on our behalf. We'd much rather work as partners. Lee Ainsley, Maverick Capital. The importance we put on management really depends on the type of investment we're making. If a company is under-earning against its industry or historical levels, and the challenge is to get things back to normal, my perspective is that if current management isn't up to the challenge, a new one will be. But in a situation where the business is growing and management's ability to reinvest capital is critical to the thesis, knowing and believing in management is very important. Alan Formier, Pennant Capital. We sometimes buy companies with bad management, if that fact is more than accounted for in the price. At a cheap enough price on a decent business, I'm willing to ride out any problems until somebody, if not current management, figures out how to turn things around. Robert Olstein, Olstein Capital Management. Handicapping the jockeys. As anyone who has ever been in a hiring position knows, even the most rigorous and reasoned selection process can result in situations in which only days after a new employee's arrival, you recognize that the new hire was a mistake. Such mistakes in assessing a CEO can be particularly costly for an investor. So it's no surprise that top money managers have clear and detailed views on what they want to know about management and exactly how they will go about finding it out. We only want to invest in management teams with equal measures of talent and integrity, because one without the other is worthless. The talent part largely speaks for itself through an objective look at performance, especially over time. Integrity is a bit harder to judge, but it's one of those things that you know when you see. Think about how you decided whom you were going to marry. You spent lots of time together. You met her family, you met her friends, you learned what she cared about and her basic value structure. We do the same types of things to get to know management of the company we invest in. It's imperfect, but to our way of thinking, nothing is more important. Thomas Gaynor, Markel Corp. We haven't tried to evaluate before they have a record who will be the superstar managers. Instead, we find people who have batted .350 for 10 to 50 years. We just assume we won't screw it up by hiring them. We take people who play the game very well and allow them to play. Warren Buffett, 2005 Berkshire Hathaway Annual Meeting. One key benefit of experience is that we've heard it all from management teams over the years and have developed a pretty refined sense of what's important and what to look for. We want to hear from management why the company has historically been successful and how, in the current competitive environment, they expect to remain so. We want to understand how they make decisions, both to see if there's a clear discipline and to assess whether they're focused on building long-term shareholder value. We want to hear their goals and judge whether they're realistic. When the new CEO of a steady grower all of a sudden wants to double revenues in 2 years, watch out. Whitney George, Royce & Associates. What are we looking for in leadership? Intellectual honesty is probably first. I want the person who is going to address the elephant in the room. It drives me crazy when you meet with management and there are real issues and they act like they aren't there. Also important is a contrarian bent, a confidence to go against the prevailing trend. You generally don't want people who are saying this is what we should do because this is what others are doing. You want people who are spending when others are not, and taking chits off the table when everybody else is putting them on. Jeffrey Ubben, Value Act Capital. We tell management that the idea is not for them to get investors to buy their stock, but to give them reasons never to sell it. When they get that, we're interested. James Rooney, Avenir Corp. It's certainly not an exact science, but we want to be convinced the people running the company are knowledgeable, capable, trustworthy, and energetic. If times are tough, we want them to be upfront about it, and if times are good, we want them to always be looking around the next corner for trouble. We believe getting to know management over time builds a rapport that allows us to pick up subtle cues about the company's prospects that others are likely to miss. Scott Hood, First Wilshire Securities. In addition to the capacity to invest behind growth, it's equally vital in our companies that corporate leadership has the will to do so, even when such investments burden current reported profits. Jean-Marie Eviard used to talk about the importance for investors to have the capacity to suffer, and I'd argue that same capacity to accept short-term pain for long-term gain is critical in management. The market often doesn't like any burden on reported profits, so adequate levels of investment often invite scorn and ridicule that leaders have to be able and willing to endure. Thomas Russo, Gardner Russo & Gardner. Access to management is very important to us. Our starting point is usually disappointment and decimated stock prices, so we need to understand fully what the problems are, how they arose, whether management recognizes them, and what they're doing to fix them, and how consistently the fixes are being applied. All of that requires regular interaction with management. We don't at all consider it a one-way conversation. We have ideas for what they should be doing, and think a real back-and-forth dialogue better brings out their true intentions. Andrew Jones, North Star Partners. If I've concluded there's an issue that can be solved, I then want to know management's plan to solve it. If there's a lot of orchestration involved, meaning they can't accomplish much in the next year or two despite their willingness, that's all the better. That means management can and will do things to ameliorate the situation, but the market won't care because the results are still 2, 3, or 4 years out. Murray Stahl, Horizon Asset Management. We're putting increased importance on our senior portfolio managers being fully engaged in the ongoing dialogue with management. That's not something to delegate and then read a report on. I have to be visiting people face-to-face, attending conferences, and sitting in on the conference calls. Successful investing, especially during times of stress, requires conviction, which is hard to truly have unless you're really out there yourself. John Rogers, Ariel Investments. Our models don't just regurgitate what the company says. When we visit a company, we have little interest in what they think they're going to earn next quarter or next year. We're more focused on understanding their business, how they operate, how they view the world. I think the companies appreciate that. Mario Sibeli, Marathon Partners. Spending time with management isn't important in the early stages of the research process. We'd rather analyze the company, its opportunities and issues, and how it has allocated capital in the past, without first being fed the party line. When we do meet with management, it should be an educated discussion between two knowledgeable parties. Charles DeVoe, International Value Advisors. We obviously prefer to invest with good management than not, but our assessment there isn't central to our process. We fully develop our investment thesis before we meet with management, and then look to confirm whether their ideas for creating value are aligned with ours. If they aren't, we're unlikely to buy, in the hope that they or their replacements eventually come around. Our experience is that you can wait a very long time for that to happen. Reagan Steinke, Westwood Management. I think I've been in the top 5% of my age cohort almost all my adult life in understanding the power of incentives, and yet I've always underestimated that power. Charlie Munger, Poor Charlie's Almanac. The first thing I do in researching a company is look at the proxy for the annual meeting. I want to see what management has done before, how reasonable compensation arrangements are, who's on the board of directors, and what their backgrounds are. Red flags include things like somebody's son-in-law being on the payroll, other related party transactions, compensation systems that aren't adequately performance-related, and board seats occupied by the company's lawyer and CPA. What's good is management with a pedigree of accomplishment in well-run companies where they may have learned something, when base salaries are reasonable and the preponderance of executive compensation is long-term and performance-driven. David Nierenberg, D-Cubed Family Funds. Character today is best judged in the proxy statement. What do they pay themselves, and how? Is their financial self-interest truly aligned with mine as a shareholder? I have absolutely no problem with the people running huge, complicated global businesses making a lot of money. The big problem we have now is that you're seeing a lot of superstar compensation for only minor league performance. Thomas Gaynor, Markel Corp. I don't think you can overestimate how careful we have to be about the incentives of people who make decisions that affect us or who give us advice. When you see conflicts of interest, it's a very good indicator that something is going to go very wrong very soon. One of the best remedies here is transparency, but it only helps if people actually care about the conflicts of interest that might be exposed. Dan Ariely, Duke University. The ideal turnaround CEO is the first-time CEO, between the ages of 48 and 52. They have 25 to 30 years of experience, but have never had a number one spot. They're seeking out a challenge, have everything to prove, and, well, they've surely done very well, probably haven't yet had the huge payday, which they badly want. The CEOs I invest in attract the best talent and have that magic combination of creativity and business acumen. That's who you want to align yourself with in this business, or in any business for that matter. Lloyd Connor, Connor Capital. We're looking for managers who have demonstrated they are killers at business execution and who have a history of always acting in the best interests of all shareholders. I'm not interested, for example, in CEOs who appear personally greedy. I frequently ask CEOs how they measure success. They often speak about meeting the needs of their various constituencies, including shareholders, employees, customers, and the community. Many have said they measure their success by the rise in the share price. The closer they get to saying they measure success by growth in the company's real economic value per share, the more interested I am. Chuck Ockrey, Ockrey Capital Management. The historical record on how management allocates capital, acquisitions, divestitures, buying and selling of shares, etc., is ultimately most important to shareholder value. But we also pay attention to the level of management and director share ownership and whether they're buying or selling. We mean real share ownership, not just options. It's rare to see excellent capital allocation without significant share ownership. Clyde McGregor, Harris Associates. If I was stuck on a desert island and had to make a decision on management talent, I'd choose a summary of past returns on capital over a cell phone call to people. Jeffrey Bronchick, Reed, Connor, and Birdwell. Because we're looking for companies generating substantial free cash flow, we put a significant premium on managers who are first-rate capital allocators and who have our interests at heart. If we find a great business, the only way it becomes a great investment is if management directs the marginal dollar of free cash flow to its highest return purpose. That's how intrinsic value gets compounded over long periods of time. James Rooney, Avenir Corp. The most important aspect of analyzing management is how well they've invested cash in the past, not what they say they are going to do. Because we typically own companies generating a lot of free cash flow, we're in trouble if management doesn't allocate that cash wisely. Donald Yachtman, Yachtman Asset Management. If the stocks we own are as beaten down as we think they are, we better see management and the board acting on the same premise. Staley Cates, Southeastern Asset Management. We think management's reinvestment acumen is something Wall Street doesn't adequately value. Most analysts are capable of developing linear earnings models, multiples, and price targets, but they're very likely to miss the extent to which smart capital allocation can compound value over a 5 to 10-year period. Peter Keefe, Avenir Corp. There are 5 ways for company management to spend money: dividends, paying down debt, internal investment, acquisitions, and share purchases. When we see excess cash on a balance sheet, we don't go with a knee-jerk response like, "You better buy back your stock," because that's limiting and can be stupid if done at the wrong time or for the wrong reasons. We focus on whether they have clear disciplines and processes for determining which of those 5 things they choose at any given time and whether it makes sense in the context of the growth and return trade-off. It's amazing how often companies say, "We like a balance of each," which is meaningless. Others say, "We buy back enough shares to offset the dilution of our stock option grants." This betrays a fundamental misunderstanding of financial management. How the shares were issued is irrelevant. You first have to know if the repurchase is attractive in the context of all potential uses of the capital. We have what we consider a best practice model for making these decisions, which we make a point to communicate early and often. Ralph Whitworth, Relational Investors. The preference by many investors for dividends is understandable, given that it's a value-agnostic way to return capital and it dummy-proofs the allocation of capital. If you look at corporate share repurchase activity over the past 10 years, it was very high in 2006 and 2007 and very low in 2008 and 2009. That's the opposite of what it should have been. So I get the argument, give me the money and I'll allocate it myself, but smart corporate capital allocators can and should create value by using the money to buy back shares at a discount. If you owned 50% of a business with a partner and he offered to sell you his stock at half what you thought it was worth, you'd do that in a second. Since you have the best information on your own company, there's value to create in buying back shares in such conditions. Brad Singer, Value Act Capital. The most important discussion we have with management is when we ask how they allocate capital. You can usually pick out the empire builders with that question alone. They tend to have a hard time zeroing in on a concrete answer. The best managers can usually say clearly and with confidence where they see the highest return on invested capital opportunities and what they expect those returns to be. They also are typically smart about buying back their shares, not just on some systematic basis, but opportunistically when they believe the shares are cheap. Robert Williamson, Williamson-Macari Investment Partners. Probably the most important part of our discipline is keeping in constant touch with management. My assistant gives me an updated list of every company I haven't spoken with in 5 weeks, and I just dial them up. Hi, John, this is Candy Weir. I'm curious whether the retail traffic we spoke about last month has picked up. Or, we've been working on your numbers and believe you can do a 20% gross margin this year. What do you think about that? Or, more important recently, I see you have a debt issue coming due in May 2010. What are your plans to deal with that? We take copious notes and transcribe our conversations so that the 4 analysts I have cranking out earnings models keep a running record of what we've learned and incorporate it into the models with my input. I always tell people I'm not looking for inside information, just for insight into how they run their business. If I'm investing at least $10 to $20 million in their company, I'm not really doing my job if I'm just reading press releases. There are always ways to ask questions of management that provide you with some insight into whether the assumptions you're making are the right ones. We either eventually get enough information to be comfortable, or we don't. Candace Weir, Paradigm Capital.